watching India Market Open, and what a week it's been. It's Friday, and it's finally Friday. If you're a trader and if you're an investor, equal. It's a tough market, now nearly 4% from record highs, and there's so much happening, Tamanna.
You know, I was talking to a veteran investor yesterday, Samina, and while September is supposed to be sorrowful, he was saying October is always weird. Something happens that you can't really plan for. And look at how October has started. Fears of a war on the horizon coming in, what was being feared for a long time by the market domestically in terms of action on derivatives trading has come in, and then you had a pummeling yesterday in the markets. Will we recover from that is truly the question. I mean, look at the kind of fall we've had from our highs on the markets, and it's really been painful. Yesterday's trade was painful. Could we see a bounce back today is the big question that we have been trying to answer. But let's begin with what the global scenario is, and unfortunately confidence has not really improved over the last 24 hours that there might not be an escalation between Iran and Israel. Quite to the contrary. This is what we saw in US markets as well. On the negative side, the Dow down nearly 0.5%, and because of these factors. The big data point that now will maybe change the mood as far as Wall Street is concerned is farm roll data, which comes in non-farm payroll data, which will be out on Friday. The expectation is that it will come in stronger than the month before, so at 150,000. The unemployment rate is expected to stay steady, however, at 4.2%. So this could be one sort of silver lining coming ahead. But as far as the geopolitical factors go, nothing positive to write home there, which is why you saw bond yields also spiking up a fair bit. The 10 years now at 3.8%. Crude has jumped. Brent now nearly at $78 a barrel. And those spikes are continuing. US crude, for example, up 8% over the last 1 week itself. Asia also feeling the jitters, and which is why mixed kind of a trade for Asia. Let's look at what the current rates are looking like. Well, some recovery there. Hang Seng is on its own territory completely. Shanghai is up 8% as far as what we're seeing. So obviously China resurgence becomes the big story there. The Nikkei up in the green as well. Not so for the Nifty implied open. We got battered yesterday. 49 points down is what the implied open is telling us. But we need to pull up what the data looked like in terms of fund flows yesterday. And you had massive sales from FIIs, over 15,000 crores coming in from foreign investors in terms of sales. Domestic investors have valiantly tried to, boost the markets with nearly 13,000 crore of buys, but no, they have been left far behind. And, just think of it. You have seen the largest selling this year from foreign investors, more than the buys in the month of August, which was about 11,600 crores, and no reprieve there. So as much as we've been talking about global money not being the biggest factor, the fact is that it has impacted us yesterday. And is it because some of that money is going to China? That's one of the things we'll ask Richard Harris, Chief Executive at Port Shelter Investment Management, who's joining us today. Richard, great to speak with you. I'm going to start, we'll come to Iran, Israel in just a second, but I'm going to start from, on your view on what's happening in Indian markets and how Indian markets are now being seen, especially considering that China is resurgent. And pull up the Hang Seng and the Shanghai index right now. We just saw a huge spike up over there. Is a resurgent China going to attract much more flows at the cost of India?
Well, I think what we're seeing, yes, indeed, China is a competitor in some ways for foreign investors allocating their money. And they probably thought, well, it's probably an easy hit to sell a little bit out of India, put it into China. Clearly, the Chinese market is on a tear at the moment. What's made it more complicated is, of course, these announcements were all done just before the start of Golden Week. So the market was open on Monday, and it hasn't opened since in China. We're seeing a little bit of a window on China, if you like, through the Hong Kong market, which has been open. It was only closed for 1 day on Tuesday. And that's continued to go up, although in the last day or so, it hasn't gone up quite as much. So we've seen this big move in China. It is in reaction to some very positive policy moves. And I think because people have been so underweight in China, they are looking to scrabble in to get at least some stocks in before the market opened on next Monday.
In terms of what Biden's commentary is, and that's the headline everywhere, Richard. If you look at the quote of what Biden actually says, and he was asked, will the US back any action by Israel on Iran? And he says, we're talking about it, and then he just sort of walks off. That's being seen as US backing Israel. That'll probably happen. How worried are you about how big that situation could blow up to? And then what's the worst case scenario there in terms of impact on global markets across all classes?
Well, we have seen this movie before. Of course, Iran launched a very large attack against Israel just a few months ago, and Israel replied in a fairly modest manner. Now, the concern is that maybe Israel will respond much more seriously, but even then, you're probably looking at targeted attacks on military or semi-military installations. So once again, it seems difficult to see that Israel can launch really an all-out war against Iran. And indeed, it's quite difficult for Iran to continue with these attacks. They're firing lethal weapons over other people's countries for a start. So the whole thing is still restricted by those criteria. Biden clearly misspoke. He probably should have said nothing. Of course, America is going to try and stop Israel from launching a major attack against Iran. After all, they said last time, take the win. And Israel has had quite a lot of wins recently. So my guess is that there may be a muted attack, or it may be slightly larger than it was previously. But we've seen the movie before, and it didn't really move the needle in terms of world markets.
Richard, hi. It's also Samina joining in. Now, let's talk about actionables, right? We've had a very solid 2024. Markets globally have been on a roll. The S&P 500, the Nifty, Japan have all eked out very sharp gains. Do you think it's now time to take profits off the table, and for the next quarter maybe we could see a risk-off trade for global equities?
Well, who would have thought that 2024 would turn out as well as it did? We've seen some spectacular moves in many markets, almost up 25%. That doesn't happen all the time, every year. We saw really in the US a big move because of the AI bubble, and that's come through, and that's been pretty well priced in the market, although, as we saw the other day, there's still money going into AI with the fundraising from OpenAI, which was spectacular. And in China, it's been slightly different. The economy has been very weak. The market's been very slow, and the authorities look as if they're now going to try and reflate the market. They promised to do so. If they can't carry on, things will be worse. So pretty well, they have to continue to reflate the market. So we've seen these big moves on two different reasons. It does seem difficult on a longer term view to see this happening again in 2025. The big moves this year, we've gone up maybe 25%. It's quite feasible that the markets could come back a third. But at the moment, the fundamentals still seem to be strong enough, strong employment in most parts of the world. Economy is not doing too badly in most parts of the world. Those fundamentals are still strong enough to really make one think that, we may lose a third of what we've seen this year, but that would be normal in line with what you'd expect in markets.
Richard, let's leave China aside and let's talk about India in isolation. I think the biggest complaint for foreign investors has been that Indian equity is expensive. But historically, India has been an expensive market. With the resurgence of China, with higher crude prices, and not a very strong earnings season, and also the fact that portfolios have made money in India, do you feel like with India in particular, you would look to take something off the table and allocate to debt, or does India still look attractive, and at every 5 to 10% correction, potential inflows could start picking up again?
I think that the latter is more likely. As a foreign investor, I think India still looks interesting. There's still a great deal of growth. The government isn't really as involved in the economy in India as it is in China, so the growth can continue to go quite organically. So I think that, there are strong reasons still to be in India. The economy hasn't really changed. It's still doing quite well. In China, the economy hasn't really changed. It's not doing particularly well. But what we are seeing is stimulus in China that you just don't need in India. And equally, these things have been a swings and roundabouts. India's had a great year this year. There may be some money taken out of India to go into China, but I would still not be underweight in India.
Very lastly, Richard, moving away from equities, are you buying into crude and are you buying into metals for the short term? I know sticky money may not come into these two asset classes until there's a significant demand-led recovery that countries like China witness. But if you were to go long, would metals and crude be a good space to go long on? And also gold, let's throw that in, given the rising stress on the geopolitical front.
Well, gold's had a great run. It does tend to move in batches, very lumpy, and it's had a great move recently. So I think maybe we're coming to the end of that period of outperformance. Other commodities, I don't really see a big pickup. The Chinese economy is going to take a while to pick up. We've seen prices move really in anticipation of a Chinese economy perhaps in 6 to 9 months' time. So once again, we've seen those prices move. The news is in the markets. It seems difficult to imagine there's going to be much more going forward. Oil, of course, has been a bit more of a conundrum because of the crisis that we've seen in the Middle East. And the big swing producer, Saudi Arabia, has said that they want to increase market share, which means putting more oil on the market. So I think that there will be a cap on the oil price for now. That'll obviously be good for India and China in terms of their economic growth. I can't see oil going to 100 unless we do see a severe supply crisis in the Middle East, which at the moment is a risk, but it's not a clear one.
Right. Thank you, Richard. Great talking to you this morning. It seems like...
Great weekend.
You too. So while India still is a long-term story...
Great weekend. Fingers crossed that the world, doesn't go ballistic. I just wanted to go over that Joe Biden quote before you come to the domestic setup, because we mentioned it briefly and we just flash it on screen. I mean, look at the panic created by a bunch of words which doesn't really say anything. He just says the US is discussing strikes as retaliation, and then he goes on to say we'll look into it and walks off. That's actually literally what he says. But I suppose coming from the US president, that's enough. I think some fear also because there's no faith that the US president, POTUS, can right now rein in Israel from a very severe counter. That's the concern.
And I think the United Nations has disappointed the world in so many ways. So I guess the onus is going to be on the superpowers. But for now, at least this morning, it is status quo with Iran and Israel currently at the early stages of war. Well, implied Nifty, like Tamanna indicated and highlighted for you, is trading flat. 43-point cut is what we're expecting. Now, let's take you through how tough yesterday was in trade. We came into work, the markets were expected to see a big gap down. We sold off for the most part of the day, finally going home at the day's low point, the Nifty trading and closing with a 2% cut. Broader markets declined in line with the benchmark index. The Nifty has corrected, remember, 1,000 points from its record high that was made last Thursday. 3.5% is the correction from its peak last week. 10 lakh crores of investor wealth has been wiped out in one single day alone, which was yesterday. A couple of factors apart from the geopolitical stress that we've talked about. We've also told you about the SEBI's curbs on F&O and the fact that there could be some passive and active money moving into China is what's impacting the sentiment. And the fact that the earnings season may not hold too much for us is the other factor that's impacting how investors and traders are feeling. Advice coming in for traders is that while you may have long or short positions, please lighten your positions as you go along. And also the recommendation from analysts is that do not run overnight positions because the news flow is moving so quickly that big gap ups and big gap downs cannot be ruled out at this stage. 48 of the 50 Nifty stocks ended in negative territory, and the top 10 contributors to the Nifty's downside led to 2/3 of the losses on the index. Reliance Industries has had it tough. for more reasons than one. The stock has been on a sell spree for the last 3 days and contributed 90 points to Nifty's downside yesterday. HDFC Bank and ICICI Bank, I think, battled it off to become the second biggest loser on the Nifty, and it was HDFC Bank that followed RIL in the biggest contribution on downside. You also had some cuts on ICICI Bank. Remember, that stock had hit a record high very recently, but now looking rather sensitive to selling pressure. Along with that, Nifty Bank was down 2%. IT lost about 1.5%. Auto, FMCG, real estate, private banks sold off over 4.5%. The only flat or green on the screen probably was metals on back of what's happening in China. Nifty Bank, remember, on its recent upward journey was up 3,500 points, but we've already given up 2,600 points on Bank Nifty in this week alone. And that is going to show you the kind of momentous sell-off that Bank Nifty has been witnessing. So we're still 1,000 points higher in the last 1 month. The fact remains we've given up pretty much most of those gains that the markets had witnessed. Stocks like BPCL, Shriram were down quite significantly. The VIX has also jumped up about 10% in Thursday's trade, going to show you how concerned the bulls are at this stage. But largely speaking, very important levels to track. You want to be very mindful. And like we've said this before, this is not the time to take on excessive risk. You want to cut down your trading positions to the tune of 10 to 20%. You do not want to run overnight positions because the news flow, like we said, is moving so very quickly. Today's trade, it could be a morning of consolidation. No material recovery is expected in the session. On the upside and downside, the levels to watch out for is 25,100 to 25,000 on the downside in terms of support. On the upside, if we do get a rebound, 25,400 could be a level that gets tested, but selling will once again emerge at those higher levels. Business updates just before the quarter earnings are rolling in. Those are going to be a key trigger for markets and stock-specific action. Higher crude will impact oil and gas sector, but remember, after a 5% rally yesterday, it stabilizes this morning. But it does seem like on Bank Nifty as well, 55,500 becomes important in terms of support. If that gets taken out on closing basis, all hell might break loose for some of those banks in trade. But all in all, we've had a tough Thursday, Tamanna, and it doesn't seem like Friday is bringing with it any cheer. We may see a small rebound, but may not be material. I think traders will use it to exit any long positions they have, or should use it.
And possibly, you would have, even those who are brave enough would not want to stick their neck out before a weekend, when, you know, so many things could happen for 2 days. And just an idea of how bad it was yesterday, just look at some of the data our research team has pulled out of the kind of impact from live highs. On just Thursday, the Nifty was down 3.9% from its live highs. On Thursday, the Bank Nifty down 4.8%. The mid-cap 150 down 2.7%. The Nifty small cap 250 down 2.7%. So that was a pummeling. Now, where were the biggest losers? Auto stocks were the biggest losers. Of course, the September numbers were less than enthusing. Reliance was the culprit here, because when you have a heavyweight that is down nearly 8% from live highs, really there's no place to hide for the index. Axis Bank was also down nearly 8%. Bajaj Auto was down 7%. Tata Motors was down 7%. Maruti was down 6%. So you've had heavyweights really take a tumble. On the Bank Nifty, it was Axis, HDFC and ICICI which were worst hit. IndusInd, Kotak Bank were also down. And we saw some of those outflows from FIs. Just in the last 3 days, 26,879 crores of FII outflows versus about 83,000 crores coming in 30 days before that. So the question is whether this continues. But let's get into some of the stocks that could be in focus. And one of the outliers of yesterday's trade was definitely the BSE stock. The reasons continue today as well. And then an important update which has come in from the BSE yesterday makes it one of the top stocks to watch for the day as well, because remember now both the BSE and the NSE has to choose one weekly expiry each, and the BSE has made it clear which one it's going to go with. So let's they've said they're going to discontinue 2 weekly index derivative contracts, which is the Sensex 50 weekly expiry that goes away from November 14th, and then they have the BankX weekly expiry which goes from November 18th, which means you're left with the Sensex 30 expiry coming in. Pancake's goes, that might not be something which is a positive. Then the question comes whether the NSE will choose the Bank Nifty versus the Nifty for its weekly expiry. They've made it clear both those options are open. But nevertheless, the fact that you have a level playing field now, that impact will continue to be a thumbs up for the BSE. The other one that we're looking at is Bajaj Finance. Remember, business updates is going to be the new big driver, as Samina also mentioned. The numbers are decent. New loan book has grown 96.9 crores. That's up 14%. Year on year. AUM has risen to 3.74 lakh crores. That's up 29%. Deposits have grown to 66,100 crores, which is 21%. And brokerages are fairly bullish on them as well. There's an MS note out, which is maintained in overweight with a target price of 9,000 rupees. That's upside of 21%. Say the healthy loan growth is above estimates. They expect the company to grow at 27.3% in FY25. New customer acquisitions are better than the target set by the company. Q2 is expected to be weak due to higher credit costs and lower margins. But remember, that's being penciled in already. And they expect credit costs to be at 210 bips and 185 bips for the second half of FY25. They also expect the management to raise their credit cost guidance. So I think for Bajaj Finance, after the kind of hit it's taken yesterday, nearly 3.5% knock, you might see an upside for those who are brave and want to take advantage of the kind of slide we saw on Thursday. DMart is the other one. Q2 updates have been decent. Sales growth at 14% versus 18% in Q1. They've added 6 new stores. Total store count is 377. Net store addition at 12% in Q2 versus 13.5% in Q1. The 5-year CAGR of 18.9% is similar to Q1 but lower than 20% over FY25. Most importantly is the number of house views which have come in, and most of them positive, from Morgan Stanley to JP Morgan to, except for Goldman Sachs, which has got a sell with an 18% downside, but a Macquarie has given an outperform. So of the 4 that we've picked, is 3:1 on an upside for Avenue. So I think in that sense, DMart deserves a bit of a thumbs up this morning. If investor mood also supports it, though, Samina, that's the big question.
Yeah, it's going to be an interesting morning, at least with regard to stocks. Another block that Tamanna mentioned is the auto stocks. Remember, you've also got that much anticipated 25,000 crore Hyundai IPO that will be hitting the streets in a week, provided market sentiment is positive, and that may not garner too well for existing listed players in the auto pack. So that could be one more reason why that whole block seems to be coming under pressure. What you also want to remember is crude sensitive. So anything that is directly related to crude will be seeing some selling pressure. So be it your OMCs, be it tire companies, paint companies. Remember, crude is a key raw material for a number of ancillary plays. So all those sectors and stocks will see some selling in today's day of trade as well. But specific counters, while Bajaj Finance had a good quarterly update, M&M Finance has had a disappointing one. This stock may see some more selling in today's day of trade. Their overall disbursements are down 1% to come at 13,160 crores. Collection efficiency remains largely flat. There were never any complaints on that front. And stage 3 collection is at 3.8 versus 4.3. So all in all, numbers slightly muted, lower than what the street would have liked to see, and especially as compared to its competitor like Bajaj Finance. M&M's Q2 update is slightly below street expectations. The stock was already down 2.5%, but could remain on the consolidation or sell side today as well. 2 other stocks that are on my radar, they come from a good place this morning, and it's the pharma names. Remember, that's one space that may be resilient or is expected to be resilient as the markets go through these very, very turbulent times. But you've got Aarti Drugs and Shilpa Medicare. In the case of Aarti Drugs, the regulator in the UK has issued a certificate of compliance with the manufacturing facility of the company's subsidiary in Himachal Pradesh. So I believe that could mean that the production of this facility could start and exports to the UK could pick up as well. Apart from that, Shilpa Medicare, they've got a subsidiary as well, which has got a clearance from the European drug authorities for a drug which is used to reduce frequent urination and bedwetting in the case of diabetic patients. Fairly large market size in that sense, and with approval of this drug coming in, the subsidiary of Shilpa Medicare stands to gain, which in turn will have an impact on how the stock does in early trade this morning. A couple of bulk trades that are worth a mention is on the case of HDFC Bank. Remember, there was some selling coming in from institutions yesterday, but you had Morgan Stanley Asia and Citigroup Global Markets Mauritius that actually picked up the supply on HDFC Bank. They bought equity of HDFC Bank worth 755 crores. Also in the case of JK Lakshmi Cement, significant block deal took place where HDFC Mutual Fund landed up picking up 0.7% stake in the cement major. You have results from Toll & Tires. That's a recent listing. They will be reporting numbers today, so you want to watch out for how the stock does. And a couple of stocks that are in the F&O ban. You've got Granules India, Manappuram Finance, Bandhan Bank, Hindustan Copper is back in the F&O ban, and RBL Bank. So those are a few that you want to track with regard to F&O activity. Apart from that, a few, you've got Tollins that kicks off the earnings season in that sense, and a brand new listing called Diffusion Engineers Tamanna that will list on the exchanges today.
Of course. I think the positive thing is if you pull up KRN, very bad day yesterday.
But great listing.
What a fantastic listing. I mean, it was like this stock was on its own journey completely. But yeah.
And it's funny you say this because there's so many times that we've attributed a grand listing to a very positive market sentiment.
Not necessarily.
Turns out not necessary. So despite a weak setup yesterday, like Tamanna pointed out, KRN had a roller coaster opening. 120% is phenomenal to say the least.
Yeah, not necessarily that happens with every IPO.
But
that's
Diffusion Engineers as well, Tamanna. 30% is what we are. Nothing is compared to KRN, but a 30% gap up shouldn't be too bad if it gets the kind of welcome we're hoping on a day like today.
All right, let's wait and see. But slew of Q2 updates is going to be the big dominant story this morning. And these are the stocks you need to watch out for. Harsh is joining us with more.
Well, financials in focus. You've got Bajaj Finance, 5.6% sequential growth. Slowest growth in over 8 quarters. Definitely something that the street will look out for, and it'll be interesting to see how the street responds to this one, because they've given a guidance of 26 to 28% for FY25 full year. When you're looking at H1, if Q2 and Q3 and Q4 Bajaj Finance were to grow at 6.3%, they'll likely clock that 28% growth number. So 6.3% not looking unachievable given the fact that you have festive season in Q3 and Q4. But nonetheless, there's some bit of tepidness in that growth number for sure. And hence, we'll have to see how the street views this. Also, in terms of how brokerages are viewing this, credit costs are going to be slightly elevated is what both Citi and Morgan Stanley are suggesting. They're saying that likely credit cost guidance will also be upped. So that's something that is definitely on our radar. The second one is Bajaj Housing. Again, 5.6% sequential growth. Overall, 26% growth for Bajaj Housing. It's grown at 32% in the last quarter and 72% up to FY25 for 7 years. Therefore, this number too slightly on the softer side in terms of growth. M&M Finance 20% growth on its AUM on a year-on-year basis, around 6% on a sequential basis. Growth being healthy, but you're seeing asset quality inching downwards. So adverse in terms of asset quality, 0.2% lower when the GNPA or the gross stage 3 2 assets are concerned, and therefore asset quality will be something that the street will watch out for, and commentary post the numbers will be something that the street will wait for. Bank of Baroda, last off, advances growth around 12% year over year, deposit growth of around 9%, deposits still trailing advances. Credit to deposit not a problem for someone like a Bank of Baroda, but nonetheless below the system, and therefore losing market share. That may be also another concern for the street.
Okay, so financials are expected to have a tough Q2. Is one point which is largely priced in. I'm just wondering if this is going to be a further impact, or with the kind of downside that they've already seen, whether we're going to be seeing maybe some of an uptick over there. That's really the question. But primary market in focus, and big news coming in from Swiggy, because Swiggy's shareholders have given a nod to increase the fresh issue component of its IPO to 5,000 crores, according to sources. Rishabh is joining with the details. Yes, Rishabh.
Yeah, what we're learning is that Swiggy shareholders have given the nod to increase the fresh issue component of its IPO from the current of about 3,750 crores to about 5,000 crores. So that's a 1,250 crore increase that we'll see. What is to be noted here is that this does not mean that the IPO size has gone up, but this is a clearance that Swiggy has received. So if it wishes to, it can increase the fresh issue size accordingly by around 1,250 crores. That would potentially take up the IPO size from the current 10,414 crores to about 11,660 crores. That would also bump up the sort of money that it is set to raise. So that is what we're learning from Swiggy. The OFS size, which is about 6,600 crores, remains unchanged. That will remain the way it is. They will only still sell 18.5 crore shares in the upcoming IPO.
All right, so more for Swiggy, and I'm not surprised because the kind of appetite that we're seeing, no wonder that they want to come in and raise even more money. But the other IPO which is going to make its debut today is Diffusion Engineers. And Samina, you think that this is going to be maybe an exciting one, even if the rest of the market is a little jittery?
Indeed, Tamanna, it may not be as exciting as what you saw at KRN yesterday, but nevertheless a good listing. It was well subscribed as well when it opened for subscription last week. It's a small one. 158 crores is what the company was looking to raise. The issue price was the range of 159 to 160 on the upside, but very well oversubscribed. 114 times oversubscribed is what we had for Diffusion Engineers. What also stood out for me is the anchor investors. So anchor investors was well subscribed to the tune of 47 crores. But you had HDFC Mutual Fund, which was the single biggest subscriber in its anchor book, that subscribed about 80 odd crores to Diffusion Engineers. So lock, stock and barrel was bought by the mutual fund when the anchor book had opened for subscription. Well, let's tell you now what sort of a listing we are eyeing for Diffusion Engineers. Firstly, very important to note that the company is going to be listing at a premium. The grey market premium is indicating to a 30 to 32% upside on the get-go at 10 a.m. this morning. A listing price in the range of 215 to 220 is what the street is anticipating as we see it. Well, a couple of other factors to watch out for in terms of what the company does. It's a smallish company, like I said, but playing in an industry that is expected to grow quite significantly if the economy gets going. It manufactures wielding consumables, heavy machinery for core industries. And when I say core industries, it goes all over, right? So from oil and gas to manufacturing to FMCG are the sectors that it actually caters to quite closely. They are looking to set up a new facility as well with the funds that they're looking to raise. Growth has also been pretty healthy, and demand for wielding construction consumables is only expected to increase as, of course, India grows and the economy sees robust demand coming in. In terms of business and earnings, the revenues came in at 278 crores. They've grown at a CAGR of 16.6% over the last 2 years. Profitability also looks quite healthy at about 30.8 crores, gone up all the way from 17.6 that the company had posted in FY22. So all in all, good earnings, well subscribed, good model. Couple of risks that you want to keep in mind on the listing day. You may see not such a great welcome if the market sentiment doesn't support it. Secondly, what you also want to keep in mind is that the economy starts faltering, then there could be a direct impact on a company like Diffusion Engineers. Apart from that, there's nothing much to be concerned about in too many ways than one. And their facility, the 4 facilities that they have is concentrated only in Nagpur. So if there are any sort of problems related to the geography of Nagpur, you may see business getting impacted. But all in all, good sort of listing expected. A 30 to 35% premium is what the grey market is indicating to. It was well subscribed. It also has some marquee, or rather one marquee name like HDFC Mutual Fund Tamanna that's come in and significantly subscribed to this one.
Yeah, absolutely. We'll see how Diffusion Engineers goes. I mean, for one thing, the appetite for primary paper is not going anywhere right now, and there's money sitting on the sidelines waiting for opportunity. Is that opportunity in the derivative segment at all? We come back from a very short...
welcome. This is India Market Open. I'm Agam Vakil, and I'm going to take you through what's happening in the futures and options space. It was a tough day of trade yesterday. The benchmarks came up at around 2%. And at the moment, we're questioning whether or not there could be a follow-on bout of selling right now. But let's take a look at how things have fared yesterday. So a 2% cut for the Nifty, even as it edges towards the mark of 25,000. A lot of unwinding coming through. Remember, especially given the fact that we saw a lot of strong rollovers towards the long side in the previous week. It does seem like a lot of that is being unwound at the moment. The Bank Nifty, well, the picture isn't very different when it comes to the spot because we did see a 2% cut there, but fresh shorts into the system even as the open interest increases by 25%. Now, we move into a new week, and at the moment what we're seeing is a little bit of, concentration of puts and calls around the 25,300 mark. But it's early days in this specific weekly options expiry. So we're going to see a development of sorts as to what kind of range the markets are looking to build when it comes to the Nifty moving in. And of course, let's move on and talk about the stocks as well. More losers and gainers, a lot of weakness in Balrampur Chini, Dabar, as well as Bata India, all of them looking at shorts. Granules India looking at longs. And among stocks which saw unwinding, long unwinding for Dalmia Bharat, Gujarat Gas, Birla Soft, as well as JK Cement. But as long as, this is as far as markets are concerned, where do we go and what do we do? What kind of trading ideas can we move around with? Well, for that, let's get in an opinion. We have Amardev Singh of Angel One who's joining us on the show. Amar, good morning. Thank you so much for joining in. What's the first stock on your radar and what kind of option structure are you looking to deploy here?
Yeah, I would say that the first stock which I'm looking at is Petronet LNG. Because if you look at this stock, the stock has, I would say, benefited despite the sharp correction yesterday. So here one can look at more from a futures perspective. So October futures one can look at the current levels or any pullback towards 360 for 363 with a stop loss below 360 and a target of 379 in the short term. Because this is one stock. If you look at it technically also, it has been holding up quite firm. And the stock has bounced back after a lot of consolidation. So this is the first one to look at.
All right, right. Amar, that's as far as Petronet's concerned. Moving on to Tata Chemicals, why is that on your radar? And again, what are you doing with this one?
Yeah, so Tata Chemicals also, I would say it has been in for consolidation. It managed to pull back very strongly. It's strong on the charts and the derivatives data has also been positive here. So here I'm recommending a bull spread for the October series. So buying the 1120 call option and selling the out of money 1160 call option. So the difference here is 20 with a stop loss of 5 and a target of 53. So in this case, the maximum profit potential is 18,150, whereas the maximum loss potential is somewhere around 9,350. So this is a second stock one can keep a close watch on because it has bounced back and sustaining above 1140, 1145 levels, it could rally towards the 1200 mark.
All right. Well, right. So those are two ideas at the moment from Amar coming through. But Amar, when it comes to the benchmark, we do know that there's been a lot of weakness at the moment. Your assessment, do you think that there could be a possibility of that fall being arrested, at least in the near term? Or do you think that there could potentially be more selling in store at the moment?
See, if you look at the markets, the way the markets have corrected over the last few days, that is more, I would say, more a factor of the events which are unfolding in the Middle East. So actually how that plays out is something which is really going to decide and define the direction of the market. Having said that, despite sell-off in the Indian markets, we've seen some very positive moves in the Chinese market. So they've been quite strong there. As far as the Indian markets are concerned, I would say somewhere on the downside, Nifty is approaching a very crucial support zone. That's around 25,100, 25,000 to 25,100. Till the time we don't see a close below that, I wouldn't be much concerned. But yes, from a short-term perspective, the top definitely seems to have been formed in the markets. So there could be choppy trading sessions based on the news triggers which come in.
All right, Amar, we'll leave it at that. Thank you so much for joining us and taking us through your views on the markets. But please do remember that if you do have any queries regarding futures and options, positions that you may need an opinion on, don't forget to write to us on the number that's been flashed for you on your screen. This is, of course, our WhatsApp number. We will take up your queries on the FNO show today at 10:30. So please do write to us. With that, it's back to you all.
So that, Agam, yes, it's going to be a difficult morning, and I guess traders are seeking and looking for help and advice on their portfolios. But we've already, Tamanna and me, have highlighted a whole bunch of stocks that you want to be tracking today. But to add to that list, Richa is standing by with more counters that the markets will be watching out for. Richa, over to you. What do you have?
Thanks, Samina. So as you rightly mentioned, there are a couple of stocks to watch out for today. Number one is Sundaram Clayton. Well, the 400 crore QIP is now open at a price of 2320, which is around 1% discount. So not much of a discount over here. So I don't think much movement in the stock price. But yes, definitely on 3rd of July when the company announced the QIP, the stock was up about 2%. Now, moving on to Reflex Industry, this one has also approved raising of around 928 crore rupees through preferential issue, wherein the promoters will infuse in about 372 crore rupees. Now, the fund is to be raised for working capital requirements, investment in subsidiaries, and also for capital expenditure. Moving on to JTL Industries, where the board has approved splitting of one share into two. The last split happened on October 2021, wherein the shares were split into rupees 2 from rupees 10. And of course, this share split will help into providing liquidity in the capital markets. And lastly, moving on to CESC. Now, the subsidiary has signed a term sheet with Bhoj Raj Renewables for 150 megawatt solar project and 300 megawatt wind project. The agreement involves securing connectivity approval, land acquisition, and obtaining other necessary permits as well.
All right, thank you for that. More stocks on your radar. Let me add HDFC Bank to that list. Their business updates have just come in. Q2 gross advances up 1.3% quarter on quarter. Gross deposits are up 3.1% Q on Q. Remember, deposit growth is the pain point when it comes to large banks, and HDFC Bank is no exception. We'll see how the street responds to those quarterly updates which have come in so far. So those bits right now, but more stocks on our watch list this morning. And let's first tell you that what is a thumbs up. We'll see how the street responds though. KNR Constructions has received a 318 crore order as a settlement between NHAI and its SPV. So that's a positive. Shilpa Medicare, their arm, Shilpa Pharma Life Sciences, has received a certification of suitability from EDQM for an API. Aarti Drugs is the other one. The UK's MHRA, that's the board, has granted a GMP certificate for the arms manufacturing facility in Baddi.
Well, just to add to that list of stocks that will be on scene, up move, Indian oil gains may be limited because crude prices have gone up significantly in overnight trade. But the good news is that they've signed a pact with Nepal Oil, though the upside could be capped on back of moving crude prices. Reflex Industries, small company, but they've announced their plans to raise significant amount of capital for expansion to the tune of 928 crores. Angel One, September average client funding was up 6% month on month, so that January looks like a healthy number for Angel One.
All right, not everything is positive though. Fine Organics, Motilal Oswal has reiterated a sell. That could be a bit tough. Bajaj Finance, most of the brokerages are fairly positive, but the business update has also shown the slowest growth in the last 8 quarters. So Bajaj Finance could see a bit of a pain today. D-Mart's standalone revenue is 14,050 crores. We're marking it as a negative because look at same sales store growth has also been a bit soft. So D-Mart could also have a bit of a bad day. Well, let's get in first calls. Kush Bora is joining us this morning. Dharmesh Kant with us as well. And we're also speaking with Sudeep Shah. Welcome to all of you, and great to have you on the show as always. Kush, let me start. After the battering yesterday, are you expecting some relief? Any signs of a relief rally you see on the chart for the Nifty and the Bank Nifty?
First, a very good morning, Tamanna. Well, hope, yes. Signs not quite there yet. See, we're back to where this rally started from. If you see the previous peak, that was close to 25,250, 25,300 levels. We're back to those levels. But the ferocity with which, we've gone down and, we've been closing on the low point of the day, I think, there could be some more pain, some more downside left. Perhaps when 25,000 is the next key level to watch for, where the support could come in. Even the put data is suggesting a congestion near the 25,000 mark. So, there isn't much to support at the moment. So, you could see some more, extension of this downward move. Now, as we were discussing, in the closing show yesterday, that on the hourly charts, both the Nifty and the Bank Nifty have gone into, serious oversold territories. But you aren't seeing any kind of respite. So, despite being oversold, you could expect a technical bounce, but it doesn't really still warrant, a big up move. The PCR, I think for Nifty it's about 0.8, for Bank Nifty 0.7. So that also suggests that, up to 0.6, there is still some room on the downside. So data points, this thing that despite the ferocity of the fall, there could be some more pain left. So I wouldn't be, a buyer just yet. Let the market settle down, perhaps a day or two of positive closing and holding on and respecting some of the support levels. And that's when you turn around and bounce. On the downside, as I said, 25,000 remains not only a psychological, but even a technical support this time around.
Sudeep as well joins in with the technical view on the markets and the derivative action. Sudeep, forget fresh trades being initiated this morning, but what do traders do who are sitting long on the Nifty from last week? Do you recommend, if there is a little bit of a recovery today, to cut your positions, take some losses and go home? Or do you recommend that they should continue to run the position for the October series on the Nifty and Bank Nifty as well, on open positions?
Good morning, Samina. See, what's happened is that this fall in the last 2 to 3 days has been very quick. Now, if you say the Nifty, it's almost 1,000 points in the last 2 to 3 sessions right from the top. So now we are approaching a very important support, which is closer to 25,000, which is the 100-day moving average. Also, as well as it's an important Fibonacci retracement area also. So I feel markets could take support here. It could rebound back to 25,400, 25,450 kind of levels because of its oversold nature and because of the extent of sharp fall in the last 2-3 days. We could see some pullback, but that pullback should be used to exit. Yes. It has to be viewed in that angle, because the way the global markets are shaping up, the way the war scenario is just increasing, and you don't know what's going to happen in the weekend. So it's much better to lighten up your positions, reduce some exposure towards longs on any pullback, and just sit quietly and wait for the Monday morning and then take a fresh trade. So yes, Nifty 25,000, 25,100 would be that important support zone, and we could see a pullback towards 25,400. Which should be used to reduce positions. And Bank Nifty, it's for Bank Nifty 51,400, 51,500 will act as an important support, being a 50-day moving average. And we could see some kind of a pullback towards 52,200, 52,300. And that zone should be used to lighten up some over-leveraged long positions.
All right, Dharmesh is also joining in today. Dharmesh, just want to get your first take on some of the BFSI updates which have come in. Bajaj Housing Finance, Bajaj Finance. We've just seen HDFC Bank, the first cut of the numbers, and we'll get a more detailed call on it in a few minutes from now. But is BFSI going to get hammered even more today, and which would be the worst hit in your view?
Yeah, good morning, Tamanna. I think HDFC Bank is going to be the worst hit. Because if you look at other updates, the advances growth of even PNB, Bank of Baroda, they were 11%, 13% kind of advances growth they have done. And the lag between deposit growth and advances growth has widened further. So that's another worrisome figure. But for HDFC Bank growing at 7% advances, I don't know whether it's a conscious decision on their part to take care of CD ratio or they are losing business to others. So that has to be answered by the management going forward. But I think they are in there for some more hammering, because the Q2 and Q3 is supposed to be a good quarter for most of the BFSI space. Where they have the growth is around 200 basis points less than what the expectation was. And at the same time, the gap is widening. So there will be worry. Our checks do suggest that there would be slippages on the asset quality, particularly from the unsecured lending and the retail division. But that will come to know only when the earnings are updated by them. So we are going with caution on entire BFSI space or till the earnings are updated by them.
Right, just a quick update on Vedanta. They've recorded their highest ever quarterly and half-yearly aluminium production. Remember, Vedanta has been on the buy side of a lot of analysts recently after, of course, what we've seen on aluminium prices on back of China's action. Aluminium production for year-on-year has seen a jump of 21%. Quarter-on-quarter as well, it's significantly higher in this quarter, up about 5%, if I'm not wrong, at 524 for the year, for the month. So, all in all, good numbers in terms of business updates. It's a historical quarter, year-on-year and quarter-on-quarter as well. Significant improvement in aluminium production, and the fact that aluminium prices or alco prices are on the upside, it seems like Vedanta could be a gainer in today's day of trade. Well, Sudeep, let's go into stocks. I know it's a tough morning and there may be only a handful of long trades, but I'm guessing, what do you have for our viewers? Any shorting opportunities, any long trades? And also what I want to ask you in that same breath is, on your recommendations, do you recommend that traders should, cut positions at the end of the day, or on your stock picks, those can be carried into overnight trade, because we are going into the weekend and the fact remains that globally as well, things are moving so very quickly.
So see, on the stock picks front, I have a couple of them, but yes, while we recommend a trading idea to anyone, the whole premise is that the risk reward is taken into consideration, how the stock is standing out, or how the stock is behaving relatively to the markets, whether it is outperforming, is what we see, and all the other parameters, whether the stock is fundamentally sound or not. So whatever recommendations we share, I guess it's important for the traders to know that. For the traders to know that yes, the stop losses are there, they have to be honored in case the stop losses are triggering, or even if the stock is at cost and you are taking it in the weekend, then it's fine. But if it is approaching the stop loss, then don't wait for that level to get triggered, exit and then take a fresh view on Monday. So having said that, there are a few stocks that I have, they are kind of outperforming in the last few sessions, where we have seen Nifty and Bank Nifty falling by 1,000 and 2,000 points respectively. Couple of stocks, say Alembic Pharma Limited. Now this stock is around 1241 levels. We feel that here in the last 2.5 months, there has been decent consolidation between 1,050 and 1,250 levels. And yesterday also, despite the markets being weak, or in the last 3 days, this stock has stood strong and relatively it has outperformed. And a lot of pharma stocks yesterday were still buzzing. So I feel from the current levels, Alembic Pharma looks good positionally, not just as a day trade. The stock is good fundamentally, so can be held also from a medium-term perspective. And this could be bought with a 1210 stop loss and a target of 1,300 on the upside. And if this 1,300 level is triggered on the upside, we could even see some further upside. So my request to the viewer would be to keep trailing their positions wherever they are in decent profits. The second stock, sorry?
Right, Sudeep, no, continue. Alembic Pharma, yes, there's also some fundamental news flow on this one. So please continue with your target price on the stock.
Yeah, so the target price would be 1,300, and once 1,300 is crossed and it sustains, I guess there are higher levels also which could be achieved here. The second stock that I have on my radar is Amber Enterprises Limited. Now, last 3 days, similarly, Amber also has seen a strong move. It has its highest closing on the charts, and I feel the way the weekly and the daily charts are shaping up, they're showing more upside here, and there's some decent outperformance against the other mid caps and the broader markets also. So this could be bought with a stop loss at 5,080, and the first target here could be 5,350 on the upside.
On our watch list today, because they've approved an anti-seizure drug. So that's one to watch out for. Kush, let's get your picks for this morning.
Sure. Two of them, one on the long side, the other on the short. Deepak Fertilizers was, holding up strong in trade. The volumes had picked up for the last 2 sessions, and a closing above the 1,100 mark is a very encouraging, close, because that was the resistance for the last month and a half. So from a near-term perspective, you're looking at an 1180, 1230 kind of targets, and 1,080 is your stop loss. On the short side, there is Bharat Forge. The stock was trying to hold on to that 1,500 support zone. Hasn't been able to, down on back of rather strong volumes. So from a near term, the pressure could continue. 1475, 1455 are the targets, and 1515 is where you place the stop loss.
Okay, so Bharat Forge has a sell call from Kush. We'll take a very short.
Back here watching India Market Open, implied Nifty is indicating to another morning of a painful start. A 50-point gap down is what the street is expecting. 25,100 on the downside becomes very important for the Nifty to track, and on the upside, of course, you want to keep a close eye out on 25,500. 63 points off on the index. Remember, we're down about 1,000 points from a record highs that was made last week. 3.8% off the record on the index. Broader markets as well have been weak. But the losses have been led by the frontline names such as Reliance Industries, HDFC Bank, ICICI Bank, to name a few. Dharmesh, what's the view on Reliance Industries? It's had 3 straight days of losses on the counter. On the way up, it wasn't a key participant, but on the way down, it seems to be leading the losses in trade. On RIL, would you be doing bottom fishing at these levels, or is it best avoided?
No, Samina, definitely. I mean, it's value buy at current levels, and lower down it will become more attractive. The reason being, if you do the SOTP kind of a valuation for FY26, our target is around 41, 4200 on Reliance Industries. So it taking its time. I know that last 2-3 months after the EGM, the stock did not pick up the way it should have been. The precise reason for that was that the demerger announcement did not come, and which I don't think will come for next 6-7 years as far as the Geo platform is concerned. Retail may still come in. But overall, if you look at the mix of things, they are shipping well, and it's a good SIP model kind of an investment on Reliance Industries. So that is what we have been recommending our client to buy at any lower levels. And the minimum target which we are looking for from 2 years perspective is 4200.
Okay. First rates are hitting, and of course we'll wait for them to settle. But remember, you have to buckle in for a rough ride, one way or the other. You might have some profit booking, further profit booking coming in, maybe some recovery from the lowest levels, but we'll have to wait and see how that really pans out. I want to just pull up all the business update candidates first and just see how they're behaving in the first few minutes. Let's look at an HDFC Bank, let's look at a Bajaj Finance, let's look at an M&M Finance. Those actually came up with business updates. We'll have to wait and see if there is any sort of up move there. On the upside right now, Dr. Lal Path doing decently. You have Signature Global up about 5.5%, but remember, these are the first rates coming in, and we'll have to look at what's happening there. Some of the crude sensitives, if we can look at very quickly, BPCL, HPCL, all were, really hit yesterday. That continues to some extent. Let's pull up an Asian Paints as well. Asian Paints also had a tough day yesterday on the street. And that's down as well. Dharmesh, in terms of value and where you can see some value, would you look at any of the auto majors for that?
I mean, if it's a long short, a long-term call, then Tata Motors does look value at current levels, and any dip should be used to utilize. But near term, I think volatility would be under pressure because a lot of discounts are coming. We have heard this festive season kicking off with discount across two-wheelers and four-wheeler segment. That's not a good sign. At the same time, inventory built-up has been high. So the sale push by the companies has not been that great. But why Tata Motor is, one thing is, again, it's a demerger candidate going forward, and the JLR business overseas are doing well, and with the rate cut setting in for international markets, ECB, UK, China, and US, it stands to benefit the most. So that is where the comfort is. SOTP based valuation is around 1400 for Tata Motors. For all the businesses put together. So that is one area where we are focusing on. Other than that, this quarter is best avoided for automobile segment.
Well, the Nifty is looking quite weak in pre-open trade. It seems like 25,000 around is where we are likely to start the day off. 25,100 becomes an important level of support. You want to keep a close eye out on that. And Bank Nifty will have 51,500. A close below that could mean further selling coming in on Bank Nifty. Sudeep, if we do get a start closer to 25,000, do you feel like there could be some buying that could emerge? Because even if it's a dead cat bounce, we've given up almost 4% in less than 5 days.
Yeah, so that's what I was, while we were discussing about Nifty, I was hinting towards that thing only, that yes, we could open closer to 25,000, but this zone of 24,850 to 25,000, this 150 point range is a very crucial support range. A lot of important moving averages are there. Plus, if you see the July swing highs are also placed in the same zone. So I feel this is going to be that important price point going into the weekend that traders might, those who are short also may not be wanting to carry their aggressive short positions at this level after a 1,000-1,200 point fall from higher levels. So I feel there could be some kind of a short covering from lower levels closer to 24,950, 25,000 zone. And given the fact that yes, next week's weekly options, if you see, 25,000 has the highest, 25,000 has the highest open interest. So that also could come into picture, and that's why I think from the lower levels there could be some recovery, and we could see Nifty rebounding back to 25,300, 25,350 thereabouts. So these recoveries will be pretty sharp, so that from higher levels, if you get these levels at 25,300 or thereabouts, you need to be quick to execute or exit your long positions if you wish to, because then the second round of selling pressure also would be equally sharp. So you get sharp bounces in between, but you need to use it wisely.
All right, let's shift our focus to the brokerage reports of the day, and a whole bunch of them on Avenue Supermart. D-Mart's Q2 growth has been underwhelming as brokerages are split on the stock. We have Mahima to tell us why. Yes, Mahima.
Right, so multiple brokerages now, a few are, positive on it. However, few have given sell rating, but the commentary on Q2 amongst all four brokerages is negative. Now, to start with Macquarie, well, they've retained outperform with a target price of 5,600. However, they've said that they're building 8.1% standalone EBITDA margins for Q2. Goldman Sachs is again negative on Avenue Supermarts. They've maintained sell with a target price of 4,050. What they're saying is that rapid scale of quick commerce is adversely impacting the same-store sales growth for Avenue, and there's a risk that FY25 store addition might end up lower than what the management has guided. Morgan Stanley on Avenue Supermarts has rated it overweight with a target price of 5,769. What they're saying is that growth is below expectations, of course, but they're awaiting management commentary and clarification on the slower growth rate that has taken place. JP Morgan on Avenue Supermart has again rated it overweight with a target price of 5,400. What they're saying appears that Q2 revenue growth is moderate at 14%, which is disappointing. However, moderation is due to extended rainfall and supply chain disruptions. However, it finds DMart maintaining competitive pricing versus its peers. Lastly, Bernstein has also come out with a note on Avenue Supermart. It has rated outperform with a target price of 6,300. This is the highest target price amongst all the brokerages so far. And it is said that DMart's consolidated revenue has beaten estimates in the 5 quarters, whereas standalone has not. And key driver will be the DMart ready for DMart overall. So this is the overall view of what brokerages are making out of Q2 for DMart.
Okay, so DMart in focus. What you're seeing on your ticker are fresh updates, and this is probably going to be a big driver today. Israel has launched fresh strikes on Beirut as we speak. That conflict, we know, is likely to expand. A new Hezbollah leader has been targeted, is what we're learning from NDTV. So that news coming in right now. Can't be good for markets going forward. Crude prices, though, not really reacting so far. But remember, they have been trending upwards quite aggressively. And some of those stocks most impacted by crude are likely to have a negative view going forward. Kush, pre-open is pretty much settled. Are you spotting any opportunities here? Because it's not as bad as yesterday, is what I would say. You are seeing some buying coming in. ONGC is doing decently today. Some of, Titagar, Varun Beverages, all of them showing a bit of an upswing. Phoenix Mills recovering after several days of being battered.
I'm glad you brought this angle up as well, because what's happened is that a lot of froth has actually gone out, and that's what I alluded to when I said that the rally is back to the levels where it started. At least on the Nifty, where 25,250, 25,300 was the previous peak, and we are at those levels now. Now that's true for a lot of stocks as well. What we saw in the week prior to the fall was that we knew that a lot of froth was building up anyway. I think a lot of these names will start to look attractive. A couple of stocks that we have on our radar, Kitex, is one of them. I think time and again, I've discussed that there is something happening in, the garment space. So Go Colors, Go Fashion, for example, has done well. A couple of other names too. So Kitex Garments is something that, I have on my radar for some time now. Yesterday also, the closing was, pretty strong, especially if you look at it from a relative basis. And, the volumes had also picked up. Today also you're looking at about 0.25% positive kind of an opening. I think this stock is positionally poised for a move towards 600. Stop on this one comes in at about 535. So a good risk reward ratio after this breakout. So Kitex Garments is something that you want to keep on, keep on your radar from a trading perspective, and even from, let's say, a positional medium term trade perspective.
You've also got delivery-based selling that some of these banks had witnessed in trade. Sudeep, we've talked about banks, but just to delve a little bit more on that, if I can pull up HDFC, ICICI Bank and see what they're getting up to in pre-open trade, we'll get a sense of what we can work with. Axis Bank as well recently made a new record, sold off quite sharply from those levels. Do you feel like today could be a good day to accumulate banks intraday, because they've opened, they're expected to see a flat start, so not too much pressure in early minutes at least?
So if we see both these banks, ICICI Bank and Axis Bank, HDFC Bank, to name them, like ICICI Bank now, post that move to 1350, has come back to that breakout zone of 1230, 1240, where it was consolidating, say, for a long period of time, right from July first week till mid-September, before it broke out on the upside. So it's back to that those same old levels, and I feel this is once again a consolidation zone between 1210, 1220 and 1260 on the upside. So I feel it's a good time to accumulate ICICI Bank from the current levels, from a positional perspective, from a couple of months perspective, not just for a day or two. This could be a good entry point from a medium-term perspective. And speaking about HDFC Bank now, this stock has given up a lot of the rally that it had witnessed in the last, say, third week or fourth week of September, right, from 1680, 1675, where it broke out on the upside. And now once again, it's back to that old breakout zone. So again, here also 1650 to 1690 zone should be used as an accumulation zone. And I feel not much downside could now be visible from HDFC Bank. There's a lot of growth now, or a lot of that move has been nullified. So I guess it's a good entry point. Might be that the stock could consolidate and we would have to wait a bit higher compared to the other private banks. But yes, definitely a good level to enter at current levels.
Right. That's the word on HDFC Bank, ICICI Bank, Axis, Kotak, all expected to see a flat start. What you also want to watch is how tech counters are doing in today's day of trade. Remember, they sold off as well very sharply yesterday for no reason apart from the fact there was broader market sell-off, and Wipro led the way down in that sense. The stock did see quite a bit of selling, to say the least. Another counter that you want to track is how L&T has been doing. It's had it rough. It's down 7% in the last 5 days. Kush, are you tracking L&T after many days? It's marginally higher in pre-open trade. Again, does it become a candidate for a short bounce intraday today?
So you're right, Samina. I've been tracking this for some time now. In fact, just before this drop, if you see a lot of these, a lot of the peers in this space like Siemens, Cummins had actually shown quite a bit of run up. They had started to move quite a bit. But L&T hasn't really participated. In fact, it's below the 200-day moving average on the back of very strong volumes. I wouldn't go out and short because now it's close to, even though it's broken the 200-day moving average, it's close to that support zone of 34.50. So the risk-reward ratio may not be as favorable. But even on the way up, there is resistance of the 200-day moving average that will start kicking in. So from a trade perspective, L&T remains in a no-trade zone. Closer to support, you might expect, you could expect, some sort of a bounce here. But that's not really something that you want to buy into just yet. And this is purely from a trading perspective.
Okay. So L&T could see a bit of a bounce back. You could see some of the worst hit yesterday having some of a bounce back. But remember, there is just no respite on the index. We are 2 minutes to open, and I just want to take you through where the pre-open rates have closed. You've seen quite a cut, 25,181. Probably and hopefully will not have as ugly an opening, but if you do, Kush, what's the call on the index today? Is there an opportunity to go short here? What are you going to be doing on the Nifty?
So, Tamanna, no trade is also a trade. You might not want to, venture a very aggressive trade at the current level and, perhaps risk losing capital. As Sudeep was saying that, a sharp dead cat bounce cannot be ruled out, but, that's what it will end up being, a sharp dead cat bounce, and very difficult to say from what level will it come about. And even if you talk about a short trade from here on, the risk reward ratio will not be as favorable, right? So I would suggest stay out of the indices, even Bank Nifty for that matter, you might want to stay out for some time. Let things settle, because we've had in the last 15 days, we've had nearly 2,500 odd points of, very wild swings. So let that settle. I think the market has gotten very stock specific. So not a bad idea to focus on some of the stocks. Index, you might want to just perhaps stay out if you don't have an existing position.
As indicated, it is going to be a morning of consolidation, but there will be a downside bias to the index. There is also a good chance that after the initial bout of consolidation, the markets may see an interim sort of up move, which potentially could be used by traders to exit any long positions that they have. As we've indicated, the best thing to do at this stage is to stay light. So if you're an intraday trader, what you want to keep in mind is go with 10 to 20% off your position as opposed to the whole haul, because currently the situation globally is evolving so quickly, and the fact that crude is higher, those factors will impact the way stocks are performing. In terms of specific movements, a whole bunch of business updates have come in, on back of which stocks will be reacting to that. At the broader level, though, banks, IT, real estate, auto may see a little bit of flattening out after the big fall that they've seen over the last few days. RIL becomes an important stock too. 3 straight days of losses. It's been the biggest contributor to the Nifty's downward journey in trade on Thursday, followed by, of course, ICICI Bank and HDFC Bank. Very flat, largely on expected lines. Like I just said, it's going to be a morning of consolidation, and after the initial few ticks, you may just see a little bit of a recovery coming in. I would be expecting that to happen, and that's really where the markets are struggling around. 25,100 is important on this level of support. 25,400 on the upside is where there will be some amount of resistance if you want to keep an an eye on. The breadth of the market is also looking okay, and the broader markets are seeing a little bit of outperformance. Bank Nifty, which has been seeing a critical amount of selling over the last few days, it's down 2,500 points after a 3,500 point rally it made. 51,500 on Bank Nifty is what you want to try. This too also seeing some bit of recovery on Bank Nifty. The breadth is not half as bad as what you saw yesterday. The bias is on the upside. Everything that led the losses yesterday is reading its way up in trade. 5% gain on crude means good news for ONGC. The stock is up over 1%. Auto counters sold off sharply. They are not doing too badly in early trade, so flattening out as we see it. Tech, like I said, has also sold off. Wipro was one of your top losers. Some of these counters will find their feet in early minutes of trade. Not to say that this is a sustainable recovery or any sort of up move should be bought into. What you want to keep in mind is be very, very frugal, at least in terms of trade right now. On the sell side, Bajaj Finance, Tamanna highlighted how the numbers were actually not too bad in terms of their business update, but the stock is getting no relief in terms of selling pressure. Asian Paints, which is a crude sensitive, is seeing some weakness. You've also got Hindalco, HDFC Bank, which continues to decline. Pharma is not looking great either this morning, and I'm not sure why defensives are selling off, but they look weak. And what stands out again is another 1% cut on Reliance Industries. This is a bit of a pain point for the markets, and if RIL continues to decline the way it does, the chances of the market making a meaningful recovery is actually ruled out for now. Auto looks weak, banks are looking still slightly somber, but on the upside I think tech and the bread's actually deteriorating as we see it. So we started off much better, but in the first 2-3 minutes itself, selling has intensified, has it? The Nifty 50 is down 0.3%. So volatile morning, Tamanna. It doesn't look like we have too much going for us, but 25,100 I think is what traders will watch on the Nifty this morning. But there you go. Look at how the breadth has changed literally in 90 seconds.
Yeah, no, I mean, I would pull up an RIL intraday very quickly, because when an RIL moves that much into negative, and with that speed, that's what you see happening, nearly 2% down right now, which is why you're seeing that kind of a pull down on the Nifty. Broader markets, let's just pull up what's happening this morning. With a mid cap and a small cap, no reprieve there either. So brace, buckle in for another tough day. Nearly 0.5% down on the mid cap, the small cap 0.25% down, at least in opening trade. Let's pull up the sectoral indices if we can, and the heat map on that, just to give a sense of whether there is anything really holding things up. Nifty IT for one, about 0.5% up, so an outlier there. Relatively doing okay. PSU banks also not half bad. The VIX up about 4%, but the big loser, again, I think at least for the 5th consecutive session, continues to be the Nifty reality. Oil and gas, energy, of course, for obvious reasons, with crude prices increasing. But let's look at specific stocks and the impact of crude. Oil India, ONGC, BPCL, HPCL, IOC, Asian Paints, your regulars, which do get impacted by crude depending on which side they are. So increasing crude impact, positive for Oil India and ONGC. Both those stocks up today. For an HPCL, BPCL and IOC, on the downstream side of it is negative, and they're reacting exactly as you would expect. BPCL worst hit, about 2.5% down. Let's look at Asian Paints this morning, and I reckon most of your paint majors will also be seeing that same kind of a hit because of crude prices and the fear of increasing crude prices. Business updates is the other big factor this morning. So you've had business updates from Angel One and Avenue, both negative right now. Not too happy. Street is not too happy with either of those updates. Angel One's numbers didn't look half bad though, I must say. M&M Finance, Bajaj Housing Finance. Let's look at some of those. That's Bajaj Housing Finance is doing okay. M&M Finance getting pummeled this morning, 5% down. Bank of Baroda has been seeing as a positive, about 1% up as well. Remember the Andhra policy to allow other brands or national brands into the state opens from today. No big support, but either for Signature Global or Radico Khaitan. Vedanta is the other one which had a business update, which looked pretty decent. Strong production data, in fact, coming in. Stock is about 0.5% down. Metals, which was, the only reprieve yesterday, not perhaps holding up as well today. And BSE, let's see what's happening to BSE. The only one which had really was spared the carnage yesterday. Today, that stock is 2% down as well. Remember, they've given up BankX, they've given up Sensex 50, they've chosen Sensex 30. Obviously, the only one left for their weekly expiry. Does that mean the NSE gets Bank Nifty, or will choose Bank Nifty, is what we need to see. 1.5% down on the BSE and falling further. So, Samina, the morning's looking rough and might deepen.
I mean, the broader markets are at the day's low points. The mid-cap and the small-cap index are seeing a cut of 0.5% at the day's lowest. And it seems like there are a few stocks that aren't doing too badly. And let's highlight those for you beyond, of course, the stocks that Tamanna has highlighted in the Stocks to News. Pfizer is up 4.5%. It's a big up move coming in on the pharma major. Remember, there were reports a few days ago that they're looking to exit the ownership of Sensodyne. So on back of that, maybe that's a big sort of money coming in for Pfizer, and that could mean why the stock is up 4.5%. ITC is trying to chart a little bit of recovery. It's not a significant up move, but after the fall yesterday, it's marginally higher, and so is Wipro. Both those counters not looking too bad. Biggest gainers are Oil India and ONGC. Of 6% up move on crude means both these counters are having their day in the sun. Oil India is up 2%, ONGC also seeing a gain of 2%. VIP Industries on back of the deal with Unicommerce is seeing a move of 2% in trade. Manappuram Finance, whose business updates have gone down well with this trade, 1.5% up move on that one. 361 Angel all trading fairly flat in early trade. On the sell side, the list is far more extensive, and M&M is down now 6%. Phoenix Mills is seeing a cut of 5%. You've also got Macro Tech, so anything real estate is again having a very rough morning after a 4.5% decline that the index saw in trade yesterday. Avenue Supermart, Tamanna has mentioned for you, Varun Beverages, Suzlon Energy, some of the other tire companies like Apollo Tubes, JK Tires are all trading with a cut of 3%. JK Tires down 3% on back of higher crude prices. Sudeep, would you consider, firstly, what is your opening remarks on the way the Nifty is opened up? It's struggling around 25,100. Is there a trade on Nifty? And also, would you consider going short on crude derivatives or crude sensitive stocks like the OMCs, because they've opened up rather flat, but tire companies are under pressure and paint stocks also now looking weak?
Post opening, we are seeing some bit of volatility. That early morning, flat opening or flat to positive opening was easily given up in the first 2 to 3 minutes, and now we are just sustaining around that zone of 25,160, 25,180 mark. From the stock perspective, if we see about the oil marketing companies, now these stocks have already fallen in the last few sessions. Now BPCL case in point 375 to 348 has already come. So I feel now it is approaching an important support at 336, 337 levels. And in case this level is not held, then below 336, yes, the stock could tank further towards 315, 318. But at this zone, I feel the risk reward ratio will not be favorable for even those who are shorting. So I feel all these stocks right now are in a no trade zone. Just give it some time, an hour or so into the trade, and then we could take a call on all of these.
Okay, so we need to sort of take a breather on what could be a bit of a volatile morning. Thank you so much, Sudeep, Kush and Dharmesh, for joining us on the first leg of the show this morning as we open up the markets to a bit of a jittery Friday. But are those jitters now going to continue? Andrew Holland joins us now, CEO at Vendors Capital, Public Market Alternate Strategies. For more, Andrew, very good morning to you. I'm not sure how good a morning it is for the markets. Let me start on, I think, the biggest question / theory floating around. Funds are moving out of India and going to China, and that's the pain we're seeing. Do you agree with that?
I agree. In some part, it might have happened, Tamanna, because obviously, the funds have been completely underweight China. And if you want to move some money quickly, then you have to find somewhere in your fund to fund those purchases in China. So I think maybe India initially was done that, because what will happen to money is that as you get money into your emerging market funds, for example, then you'll probably put more weightage towards China. India will get some, whether it's in terms of a neutral weightage or underweight within that new money, but that's still to come. So I think in the short term, we're seeing some money just taken off very quickly. Let me get into China, but I don't think it's like I'm going to go underweight India and overweight China. I still think there's quite a lot of skepticism out there to see that some of the policies which the government's still talking about in China, like fiscal policy, is going to be followed through. So that's what I would say. It's a very short-term move, I think, and I don't think it's going to be long-lasting in terms of flows away from India to China. New incremental money, obviously, if China's still looking good, then you would probably put more weightage towards that.
But let's talk about India now, Andrew. How do you feel going into the earnings season? Very quickly and swiftly, the markets have given up nearly 4% from a record high that was made only last week. Do you feel like some bottom fishing, value buying for an investor now could be a good time to start adding incremental capital?
I remember when we last spoke and we were, the markets were at highs, and I all the negatives that we could talk about then just didn't matter. And coming into earnings season, if you remember, I said that I wasn't very excited. I'm still not excited. I think it's going to be a weak earnings season. And unless we start to see the government capex and private capex pick up very quickly, orders given, then that kind of multiplier effect, that kind of impact for companies is probably not going to be felt as much in the second half. So you're not going to get that earnings increase. So therefore, valuations were always a tough one when we were hitting highs, and we've just became overbought. So a combination of many factors, including China, has probably just taken a bit of froth off the market, which is no bad thing. So I'm not overly negative. I'm just kind of cautious because I think the earnings season will not be great.
Earnings season will not be great is something that people are saying, but what are the pockets that are bothering you the most, Andrew? Is it on the consumption side? I mean, the initial sort of numbers coming in from Avenue, same sales store growth numbers, for example, or from auto sales in September, that's raising some question marks. On the other side, you have a whole host of BFSI updates, which are not that great either, at least at first glance. So which are the sections which are worrying you the most when it comes to Q2 numbers?
I think you just mentioned them all, Tamanna. I think those are the areas.
Two of them. Those are the two worst.
Well, BFSI is quite a large sector across the board. Autos, obviously. So I think the only kind of positive I can see from the earnings season is probably the kind of more commodity based companies. But otherwise, I think it's going to be a weak earnings season. Narrative around the future is going to be key. So there's going to be pockets of companies that do well. I'm not convinced the IT sector is finally there at the bottom yet, and it's had a good run. I'd probably do more of my bottom fishing around the banking, where we're probably getting closer to the bottom there, and valuations are more compelling than IT.
Right. Andrew, well, we've talked about business updates and sectors that you're tracking fairly closely. What happens to the way crude is currently moving? With rising geopolitical stress, it seems like there could be some more gains on crude prices. How do you think that's going to, what is it going to do for our macros, A, and B, in terms of crude sensitives? Are those sectors or pockets of the market best avoided for the foreseeable future?
Yeah, I mean, from a trading viewpoint, obviously, they become, some of those sectors where the inputs are with oil, they become, favored shorts, right? But you're really playing a geopolitical kind of, trade there. And I'm not saying that will go away from us. We'll have to wait and see what Israel does over the next next few days, actually. So the weekend is probably important in terms of any development there. But it's really a trade, I think, to do that, because if anything kind of breaks in terms of any kind of ceasefire or anything like that, then the oil price will come tumbling down very quickly. So I think it's something that you trade rather than it's a long-term view that the oil price will remain where it is or a lot higher for a lot longer. Because if it does, then obviously it has a global impact in terms of global growth, then interest rates and so forth and so on. So it's a it's a bigger play, not just an India play. But I think, India's obviously buying its oil from elsewhere. So, hopefully it will keep the inflation figures down. But what it does do is probably edge the RBI to be more cautious going into its monetary policy meeting next week, and therefore any hopes of that kind of maybe small pivot in interest rates coming lower after the Federal Reserve has probably been tabled or put aside for the moment, and therefore December becomes the main play.
Andrew, in a lot of our previous conversations, you've talked about coming in when there's a bit of correction in the market. Has the bit of correction now taken place? More to come? Are you seeing levels comfortable where you want to start buying again?
No, I think the one which I'm looking at a little bit more closely is the banking sector. Again, it had a good strong run on some of the factors we talked about before, Tamanna, in terms of global interest rates falling and the likelihood of interest rates falling here. It's coming to a point now where it's getting to that oversold territory. So it's becoming, as I said before, it's becoming in terms of, I think the earnings are starting to NIMs are starting to bottom out, and therefore it's a place where I'd look to bottom fish a little bit more because the valuations are more compelling than other sectors.
Given that everything is now going to be more homebound and homeward looking, especially with everything that's happening globally, Andrew, I know you like hospitality and we've talked about this extensively. Do you still feel like this is a space you want to be going long on? Any of the new sectors that you've identified that could become potential long trades? So maybe mass consumption, maybe luxury spending, anything that stands out there for you?
Yeah, well, I think, given the markets recently, I think probably everyone would want to go on a holiday. So I think hospitality remains, something which I would continue to favour over the next 2 years. Premiumization in beverages doesn't go away. And if anything, the power sector, I think, is ready for, to see quite a lot of contracts being awarded. So I think the power sector is something which I think is going to be a theme which will start to play out over the next 6 to 9 months gradually as more orders are given and as we see, that demand is obviously very high and will continue to be high. So, look at wind power, look at renewable power, and I think that's where you're going to make some good money over the next 1 to 2 years.
Thank you so much, Andrew Holland there. Q2 is looking a little jittery. That's one of the reasons I think that you're seeing the markets in a bit of a funk. But HDFC Bank is in focus this morning. A lot of updates coming in, and their quarterly updates is going to be one to focus on. The stock is stabilized now in the red, but not too bad, really. Harsh, what are the big takeaways from the HDFC numbers that they put out so far?
Well, Tamanna, first off, with regard to loan growth, you've seen sequentially loan growth going up by around 2%. Now, HDFC Bank this time around changing the way it's reporting some of those Q2 or quarterly numbers. And essentially what they're saying is that their average AUM or their average assets under management have grown by 1%. So they've started disclosing quarterly averages so as to not have any chunky amounts at the quarter end to impact those growth numbers. That's what they're essentially doing. Now, in terms of where we are on the deposit growth, because that's one number which everyone is looking at, 5% growth on the deposits front on a sequential basis, very, very strong. What this does to loan to deposit is brings it down from 104.5% at the end of Q1 FY25. Now loan to deposit is down to 100.7%. And that number will further come down if the loan to deposit differential in terms of growth, absolute growth, is over 2% or more. Very quickly, the loan to deposit ratio will come towards the 95%, maybe in 2 to 3 quarters. Maybe by the end of this year, you might see HDFC Bank's numbers, loan to deposit number come to 95%, which is quite positive, which will allow the bank to start growing again at a rapid pace. Now, in terms of what within deposits is growing, well, CASA has done fairly well in this quarter, 2% uptick in terms of CASA, but average CASA balances have actually degrown by around 0.5%. Very high base of Q4 continuing to impact. Of course, Q1 was impacted, but Q2 as well on the average balances. But overall, on closing balances, they've done fairly well where HDFC is concerned. Time deposits or term deposits have grown by nearly 7% sequentially. So that's where a bulk of that deposit growth has come from. Last off, with regard to shareholding, they've also disclosed their shareholding pattern. The foreign headroom, or rather the availability of foreign headroom, was supposed to be 20%. It's currently at 25% as per the shareholding, which means that the MSCI rejig or the weight rejig will likely happen from 0.75 to 1% in November. And if that is to happen, likely $1.5 billion worth of money to flow into HDFC if that rejig were to happen.
All right. Thank you for that, Harsh. So HDFC Bank in focus, a whole host of, remember, you have had a whole host of updates coming in, and that becomes very, very important in a market's perspective. But the other big factor, apart from Q2 numbers, is what the festive season is going to look like. And to speak more on that, I'm joined now by Suvankar Sen. He's MD and CEO at Senco Gold. Mr. Sen, great to have you on the show, and thank you so much for speaking with us. Now, this is one segment that has, I think, bucked all trends of demand, etc. There has been really no, fatigue there from consumer point of view. What are the kind of sales you're expecting in the festive season? Remember, this festive plus wedding season around the corner.
See, so, if we really look at it for the industry overall, post the budget cut, the duty cut in the budget that happened, that kind of triggered the sales and the demand for the consumer in Q2. And July and August went on very well till it was September when, due to the Fed interest rate cut, that the prices of gold shot up. And in the last 15-20 days, the industry saw some amount of, I would say that, people waiting for the festive season to start. The Pitri Paksh was there. But considering that, we have Diwali, Dhanteras, and the wedding season, I'm assuming that compared to last year, there will be an increase in terms of value of business for everyone, about 10 to 12%, because we have to keep it in mind that the gold prices have moved up considerably compared to last year as well. So yes, there could be impact in volume with the increase in prices, but overall we are expecting a 10 to 12% increase from last year.
Okay, 10 to 12% increase from last year. I just want to understand, Mr. Sen, gold prices have been going up consistently. This is not being a dampener at all to demand?
See, there are two parts to this. One is the value growth and one is the volume growth. So, when the gold prices are going up, consumers, when they have to buy something, whether be it for weddings or personal purchase, there is always a budget that everyone keeps in mind. And if we look at the overall growth of the economy, then, there might be a marginal increase in the disposable income that will go on to this sector. So that is one part of it. So value-wise, you will see some growth always. But yes, if you ask of the volume, obviously, because the gold price is going up, there will be volume degrowth, and that volume could be anything, 5%, 7%, 10%. So, but value-wise, you will always be able to see. So, till the economy is doing well and everyone is, earning better, I think that we will be able to continue to see a growth in the sector.
And then it's a fair assumption for us to make, it's Samina joining in as well, that on the volume side, revenues are going to be muted, and that's because higher gold prices have impacted the buying capacity of your clients. So while value will go up, because that's largely driven on back of higher prices, right? So, if not a fair assumption, not fair to say that you will see a massive upside because volumes will remain muted. What I want to understand from you as well, are you considering any strategic pricing adjustments to manage the volatility in gold prices, and how could this impact margins?
So the pricing adjustment happens for our sector
different from various other sectors is the fact that on a day-to-day basis, based on the international gold price, the selling prices keep changing for everyone in the retail sector. So I don't see too much of price change. We will have to, if the prices internationally go up, we do charge higher prices to the consumer. But yes, with the festive season coming in, what happens is discounts and schemes and offers, they start, getting built up into the whole ecosystem. And I think that is how we want to pass on certain kinds of discounts and benefits to the consumer. So I don't see too much of change in the margins. It will remain in a similar manner that it was last year. And rather with an increase in gold price, see, at one end, all the various retailers, they do hedging. So they don't get the enjoyment of the gold price rise. But at the same time, there are impacts that, they get in terms of benefits on the margin increase. If the diamond jewelry sales goes up, then obviously there is a possibility of margin getting increased. So if we really look at it overall for the industry, Q1, Q2 was kind of slow for the diamond sector. I know people were looking more at gold, there were less weddings, but I think those were the factors that will keep on and come into the picture in Q3 and Q4 and will help the industry to have some kind of a better margin.
And I'm glad you bring that up because that was my next question, Mr. Sen. With gold prices on the uptick, are you seeing improved demand for non-gold? So I'm going to put silver and diamond in that bracket. And do you anticipate better sort of projections in terms of sales outside gold for business? And what does silver and diamond contribute to your top line as well?
So silver, jewelry or silver utensils, they contribute about 2 to 2.5% to the top line, and diamond jewelry contributes about 10 to 12% in the overall sales. So I would say that with this increase in gold price, people, and we saw it in the last financial year and the year before that as well, that people were preferring to buy 18-karat jewelry, 14-karat jewelry, which made it much more easier for them to buy. And when you buy 14 or 18-karat jewelry, it's mostly everyday wear and Western design, which is nicely studded with diamonds and gemstones. So I think that, yes, we would expect a little more demand in diamonds and gemstones for the coming season.
Mr. Sen, going forward, if you could just give us some details about your fundraise plans. What is the quantum of it? What is the timeline?
So, we will be, having our board meeting soon, and we'll be, finalizing the range of how much funds to be raised. But it will be in the range between, 400, 450 crore approximately. And that would only be enabling us in the future, with the expansion plan that we have of opening stores, 18 to 20 stores every year is what we intend to open, a mixture of company-owned, company-operated or franchisee. So that is how we will want to utilize most of the fundraise that we do. So let's see, we will take it as it comes and, hope for the best.
Right. Mr. Sen, with gold seeing a sharp up move this year, how do you manage inventory? Would it be fair for us to assume that you should be seeing significant inventory gains because prices only move one way, which is up?
Yes. So obviously, when the gold prices are moving up, one gets to see inventory gains, and that is where hedging comes into the picture. So, for example, the company like us is doing a hedging of about 75-80%. Some companies do 100%, some does 60%. So, based on that, for the quantum which is hedged, you wouldn't really have a benefit of the price rise on the books directly. For the unhedged portion, there is this upside that is open up. But I guess that that is where we need to balance it out, or else you would see, windfall gains in certain quarters and windfall losses in certain quarters because of the volatility. And that is a very much part of the ecosystem and the risk that we have to work with. So that's how one has to look at it, and the benefit will not fully pass on, but partially to the extent that you are.
And it's a fair assumption for us to make that it's actually not a win-win situation for you despite higher gold prices, because if 80% of your inventory is hedged and higher prices are very clearly going to be impacting your volume growth, And to add to that mix is the fact that you need more money to manage liquidity and working capital. Do you feel like is that the right way to look at it, or should it be the other way around, where the next 2 quarters your earnings will be phenomenal?
No. The first thing that you said is the right way to look at it. So while we all know that with the global uncertainty, the war happening in the Middle East, the Fed rate cuts, the uncertainty in the US elections, there is a very high possibility of the gold price be on the upside. But heart in heart, I wish and I think the industry wouldn't want such high increase in gold prices in a short period of time. We are all, hoping that, okay, there could be corrections and consumers also feel good and they will come and buy more. But yes, what reality is reality. So we need to wait and see what it happens, but that's how it is.
There are some concerns, Mr. Sen, about demand sort of flagging. Are you seeing any signs of that in the kind of quality of purchases being made?
See, I'll tell you, July and August for the industry was very good. And September, obviously, because the price really nearly jumped pretty high in the short period of time. So September was kind of a slow month for the industry. And October is again, the festive season is such that no matter what the price is, consumers do buy and it is a big growth compared to the normal business. So I don't see it happening. Like, for example, September was slow, August was very good. So it's every month on month is what we need to look at. So I'm sure that October and November will be a good month for this season.
All right. Thank you so much, Mr. Sen, for speaking with us. And, as we track the festive season and how important it is definitely for a huge number of companies, at least on the gold jewelry side, the view is definitely positive. So thank you for joining us on that. Okay, let's turn focus to markets and let's pull up the heavyweight, Reliance Industries. And this is one reason why the markets have been seeing some pressure coming in for the last few days. A recovery from its lowest levels now. Reliance stock still about 1% down now compared to how it was in the on the opening session. But Reliance has been underperforming for some time now. Now there's a report out by Ambit on Reliance Industries, and Mihika, they talk about some of the concerns they see to justify their sell call. What are they saying?
Yeah, they've highlighted several aspects, whether it's segment related or on their balance sheet. Let's first start up with the delays in new energy. Now, back in 2020, Reliance stated that new energy will emerge as a growth engine for the company, and that's what brokerages were also betting on as the next leg of growth. But 2 gigafactories have seen over a year of delays, and no targets for the electrolyzer, fuel cell, and power electronic segments have been set. When you talk about the impact of new commerce, which is next, now Reliance, as per Ambit, it was a late entrant in the e-commerce market, and the new commerce revenue contribution, which is apart from Jio, has been stagnating at 18% with annualized revenue of around $4 billion. Now, the revenue growth in both traditional as the next point that they've spoken about is Jio, which is lacking market depth. Now, the company had set targets from the platform vision for Jio, but these targets have been revised lower over the past few years, and they've also highlighted how Jio's capex is down 2% in FY24, which marks an end to the 5G investment cycle. The next factor they've spoken about is cash flow from operations. Now, the consumer business accounting profits do not align with the underlying cash flow generation, is what Ambit says, and they've also highlighted how the cash proceeds from asset sales have risen to 10% of cash flow from operations, which is a 66% rise in FY24 and approximately 5 times from what we saw between FY22 and 24. And they've said that Reliance is now increasingly relying on asset diventures to bolster its cash flows. They've also spoken about growth rate, how the company's growth rate is largely similar to peers, but revenue and profitability growth from the consumer business is slowing. And lastly, it did speak about valuation. It spoke about how premium Reliance's valuations is. Its forward valuations for FY26 is at an 18% to Nifty's 1 year forward, and they expect that the large uncertain capex outlay to keep the return ratios lower. And lastly, they've said that the valuations remain unjustified because of the long project gestation periods and the uncertain investments that could lead to only a 5 to 7% return on capital employed over FY25 to FY27.
All right. Thank you for that. So quite a bit of concerns raised there in the report. I'm speaking now with Prabal Sen, Senior Research Analyst of Indian Oil and Gas Sector and Institutional Equities at ICICI Securities. We'll be joined by Deven Chokshi in just a minute for someone who tracks the company very, very closely. Prabal, let me come to you on some of the points that Ambit has raised. And let's talk about new energy, because that's something that you look at carefully, where they say that in 2020, RIL stated new energy will emerge as a growth engine, but there has been a delay of at least a year in 2 gigafactories. Let me come to how the stock has been performing right now and whether you're seeing any signs of concern.
I think, I would hesitate to comment on what some other broker has written, to be absolutely clear. I think the author of that report would be better placed to sort of comment on it. Having said that, I think 2 or 3 key concerns that have been mentioned, which is something that we concur with, is that the cash flow generation from the businesses is definitely running a little bit behind what initial expectations were at the beginning of 2020s, when the announcements were made both for new energy as well as the expectation that people had from Geo as well as retail. So to that extent, the FCF yield, if you see, which is the free cash flow yield from the business, that has actually remained subdued. It was in fact probably negative in FY23. It had a small positive return in FY24. And our expectation is that that number will continue to remain at the sub 2 to 3% level. So that is indeed, something that gives us, makes us a little bit cautious in terms of Reliance's prospects. As far as new energy is concerned, yes, there has been a little bit of delay. I think, what needs to be understood, given the complexity of what they're trying to achieve, create an integrated ecosystem across, solar, hydrogen, batteries, fuel cells, and so on. It was always going to be challenging, even with Reliance's execution skills, to basically get everything done in the stated timelines. And that is something that is playing out. I really don't think that that will impact the prospects for the stock at this point of time. I think people still have a lot of faith that as and when these businesses pick up, they can actually generate superior returns and can diversify the earnings mix for Reliance. But in the near term, what is really happening is, at the same time, while Capex is again ramping up on new energy and there is a little bit of delay, the momentum in retail seems to have slowed a bit. And in the business, in the traditional business of OTC, the kind of volatility that we are seeing in terms of margins is also causing a little bit of concern, because if this kind of a weakness actually persists, then that definitely has an impact on the earnings trajectory in the near term. When I say near term, I mean in the next 12 to 18 months. So that sort of is, all of it is sort of coming together and probably impacting the stock at this point of time.
Deven, good morning. It's Samina. Thanks for joining. And Deven, you've tracked Reliance for more than 2 decades. There are reports by Ambit where the concerns go beyond the temporary or near-term adversities in that sense. They actually believe that there is no long-term trigger for Reliance Industries. And I read a note or a comment by you yesterday where you said, despite these adversities, Reliance should be bought into. You want to justify why you're looking at this as glass half full as opposed to half empty?
Yeah, good morning, Samina. Well, I think you have to look at the business of the company in 2 parts. One, the industrial products, which is driven by the oil to gas exploration businesses, and the consumer segment of business, which is driven by the Geo platform and the retail, particularly. Media included, but I think more importantly, these 2 areas, I think, important. Now, when you look at, I think, the retail and the Geo platform for, say, consumer-facing business, you find that they are cash accretive significantly. Geo is operating on a run rate of 120,000 crore revenue top line and 60,000 crore EBITDA. Same as the situation with retail, wherein I think the numbers are significantly large from the point of view of revenue as well as from the point of view of EBITDA. 7.5% to almost 8% kind of EBITDA margin on a total turnover of close to somewhere around 3 lakh crore run rate, I think is what I think this particular company is all operating about. So in my viewpoint, I think when between the two businesses, the EBITDA contribution is around 85 to 90,000 crores. I don't think that I think one is basically seeing any kind of degrowth or any kind of I think doubt in this business. On the contrary, both these businesses are growing at a steady rate of Geo is growing at a steady rate of 20%, and the retail is growing at a steady rate of around 15%. With additional brand, I think from their own stable is also going to be promising from the point of view of larger EBITDA margin and at the same time the digital platform. Now coming to oil to gas business, industrial businesses, this business is a commodity in nature, of course, but I think the way in which this company is revamping this business, they have actually changed the feedstock, and as a result of which the profit margins are remaining intact. Otherwise, this commodity business has a tendency to bring down the profit margin to some 1%, 2% level, which is not the case here. And at the same time, they remain extremely cash accretive. Out of the total EBITDA of last year, I think almost 60% of the EBITDA comes from this business. So in my viewpoint, I think nothing fundamentally has changed. Maybe the market technicals are ruling in the minds of the analyst, wherein I think more amount of traders who are basically wanting to short the market, they find the best ground in form of Reliance, HDFC Bank kind of stocks, where the weight is higher. So that's where probably I think you are basically seeing the weakness.
That's a fair point. I mean, if you want to short the market, I mean, that's a heavy weight. But, you know, apart from the technical point of view, let's come up to the fundamentals. And one of the points that Prabal was making, of course, the group has now diversified away from the energy business. But going ahead, Prabal, do you see any of the factors that you mentioned actually changing or improving? What is the outlook looking like? Are these temporary blips or now more systemic issues?
No, I think one of the clear shifts that Reliance has been trying to make, and successfully so, is to reduce the reliance on OTC business in its overall EBITDA mix. If you look at what OTC was as a percentage of overall consolidated EBITDA a few years ago, where it was easily more than 55-60%, it came down to around 48% in the last few years. And as the momentum from Geo and retail picks up, we see OTC getting down to somewhere around 28 to 29% of the overall EBITDA mix. So, I take the point that Mr. Devin just mentioned about even within OTC, improving the fuel mix and getting into more and more specialty chemicals, as reducing the kind of cyclicality that is inherent in a traditional refining business. But even the overall pie itself should actually reduce as a percentage. So that is something that if they can actually execute well, should augur well from a cyclical and a predictability standpoint. The second aspect, which is basically new energy and the kind of momentum that Geo and retail will bring. Geo very clearly, our telecom analyst, I think, is very, very bullish in terms of the profitability growth from Geo that can actually be expected over the next few years. I think if I look at our estimates against 560 odd billion of EBITDA that they reported in FY24, the expectation is with the kind of tariff improvement that's happening, they can easily do close to about 920, 930 billion odd. So these two definitely, the only question is, does this kind of earnings growth continue to come at a very high cost, which is to say that does the capex momentum actually keep up with the earnings growth? And I think that has really been the story over the last 3 to 4 years, where earnings growth has definitely been superior than any other peer in its market cap category. But that has continued to come at a high cost. Therefore, ROEs and ROCEs have remained at sub 10% level.
Right.
So,
Prabal, in that case, I mean, the stock has largely done what the index has done. For the last 1 year, it's done 21%, despite the fact that it's a high growth engine, like you said. Looking ahead, are you recommending that the current weakness should be used as an opportunity to add to positions of RIL? Or would you say better off to avoid right now? There are better opportunities in the market if one is looking to generate or create alpha for their portfolios.
See, over the last 1 year, we've had somewhere between a hold and a reduced rating on the story, precisely for the reasons that I just mentioned, that while earnings growth continues to be segment leading, there are definitely triggers that should ensure that their EBITDA growth and their net earnings growth will continue to be in the strong, mid double digit territory. and there are definitely prospects of complete transformation in terms of the business mix. That is offset by the fact that, the capex reduction or the slowdown or moderation in capex run rate is definitely happening at a slower pace than what we would imagine. And that is something that has been true for the last 3 years. And as you rightly mentioned, the new energy delta, while it would take some time to come, is already captured in most street estimates. Most people, including us, are giving 1.5 times capital employed to the initial plans of 70 to 75,000 crore that was announced. And despite that, we struggle to get beyond a fair value of somewhere around 29 to 29.50 a share. That has been our stance, and frankly, that remains unchanged at this point of time.
Okay. Our focus on RIL this morning. Devin bhai, just one question from you, and let's talk about retail. So some of the concerns in that report as well is about the growth in retail. Geo is on one hand of it, the capex issue comes up, but on retail, are you comforted with the pace that we're seeing?
Actually, I think I would be extremely comfortable for a simple reason. They are an end-to-end solution provider. On one side, you have your own brands. On the other side, I think you have got your own distribution reach, which is, I think, connected along with your payments. So I think the entire POS terminal that they have, which is basically, I think, helping them in managing the complete supply chain logistics, is giving them a power to basically cater to the demand in respective stores, respective regions, including GeoMart. At the same time, their omni-channel product model, which is basically giving them on-ground stores, at the same time digital deliveries, both synchronized at one level, which is an unbeaten proposition at this point of time. So in my viewpoint, I think retail is a steady grower. Most importantly, given the global experience of retail, most of the retailers would end up earning margins of around 2 and 3%. Here, this company is talking about earning margin of 7.5 to 8%. So certainly, I think there is a much more power left at this point of time, as I see. And some of the large retail franchises that they have, including electronics, I would think that they are basically generating significantly large amount of growth. Given the choice, once would have Geo Finance connected with the retailing, I would think that the business would probably expand along with the market share. So one would remain bullish about the prospects and the possibilities.
All right. Thank you so much, Prabal and Devin, for speaking with us today. RIL in focus as a heavyweight, which has been flagging for the last few days and having a rough time. But having said that, markets have turned positive, and that's good news. The Nifty now, at least flat, a second ago was in the green. Let's look at the Bank Nifty and IT. Bank Nifty also doing decently, we're 114 points up. And the Nifty IT really about nearly 1% up. So the bulls are fighting back as we wrap up on India Market Open. But stay tuned.
welcome. You're watching Talking Point. It's a volatile Friday on D Street. The markets are oscillating between gains and losses, but it seems like a little bit of a base could be made for the day. You're now watching Talking Point, and I'm Samina Nalwala, and of course, we are now going to be talking to our guest for the day, Naveen Chandramohan, founder of ITIS Capital, joins in. Hi, Naveen. Very good morning. Thank you very much for joining us. We're talking to you on a day when the markets have been tumultuous. The last few days have been rough, to say the least. We're off about 1,000 points from our record highs last week. But when you quantify that into percentage, we're only 4% lower than our recent highs made on the Nifty. What I want to understand from you is, with the rising geopolitical stress, how much of that is already in the price, or do you anticipate another 5 to 10% correction from these levels?
So, very good morning to you and all your viewers. Thank you so much for having me. So, as you said, I think we are off the highs, but within that, there is a lot of sector rotation that is currently happening as we speak. So, I think what you're seeing for the first time is, while pretty much most fund managers, including myself, are positioned more so from the risk reward, not sacrificing liquidity, the small caps continue to do well. And one of the reasons for that is, from a structural perspective, India is in a position not seen after 15 years, where ROE as an industry is expanding, right? So I think while we can talk about corrections being par for the course from here over the next 6 to 12 months, I think risk management and positioning becomes extremely important. So what do I mean by risk management is, how do you ensure downside is protected during every such fall? Because even today, when your markets are off the highs, you still have power doing well, oil and gas doing well, you still have consumer durables doing well, auto two-wheeler doing well. So end of the day, it's not like every sector is going through volatility. You still have pockets doing well, as a result of which is what I'm talking about, sector rotation going to be increasingly important from here.
And I mean, you're right. I mean, at the end of the day, returns are a function of the markets, and the only thing we can really do is manage the risk, and that's pretty much critical. You know, you talked about sector rotation, but I want to talk about market cap rotation. From mid last year towards the end of last year, most people were propagating that the value remains in the large cap space, and that's where portfolio biases should be. But at the first sign of stress, which we've seen in the last 4 to 5 days, large caps that had began a rally have already gotten sold into. Do you feel like a sustainable recovery in large cap names is a far cry, even though they do have a better risk reward at this stage?
Absolutely. So I think that's a great question that you ask, and it's very important to classify large caps, right? Because India large caps is one of the most diversified sectors in the world, with a bias towards banks. Now, if you look at our portfolio, we've been underweight banks for a good part of 4 to 5 quarters, and I continue to maintain that stance. So for us, large caps does not mean bank heavy. Though valuation-wise it looks cheap and reasonable, I still worry about a bit more on the ROA expansion side, and the quality of growth may have a bit more of 2 to 3 quarters to see, especially from an unsecured lending perspective. Where I'm talking about from a large cap perspective is a mix across pharma, non-lending financials predominantly dominated by insurance, power, oil and gas. These are the places where I see sustainability of growth, and that's where we would position ourselves towards. So a broad basing of just moving from small cap to large cap without giving context of how you want to position yourself, I'm not sure is a blanket statement that I would like to make here.
You know, Naveen, correct me if I'm wrong, but you mentioned oil and gas. Let's start with Reliance Industries. The last 4 days, it's been a key contributor to the Nifty's downside. There's a report out by Ambit that says that the growth triggers of its new energy have been delayed. There's delays on monetization. There's delays across the board through its different verticals as well. How do you feel about that? Do you feel like a lot of the good news for RIL is in the price, and the stock hasn't done much, even though it has superior earnings in that sense. That was an RIL question, and also beyond RIL, the oil and gas pack seems to be so sensitive to what's happening to crude prices. Do you feel that stocks like ONGC and Oil India could continue to gain, but OMCs may once again go back on the sell side?
Sure. So first, coming to Reliance, unfortunately, Reliance, underneath the balance sheet are multiple businesses that is just not oil and gas and energy dependent, right? So you still have the core energy business, which I think should do well. And you still have the telecom business where you will have to take a view on when the demerger is going to happen. Maybe it's going to be 5 to 7 quarters away, but that continues to be a very good cash cow because telecom as a sector is in an upcycle. The issue from Reliance's perspective, what you're talking about where the share price has not done much, comes from the retail business. So end of the day, for you to generate shareholder IRR, you need ROEs to accrete. And retail business has caused a drag on the ROEs for a good part of 2.5, 3 years. So unless and until you see the retail business picking up, you are going to have a drag from a Reliance perspective. So you have two businesses which are actually doing well from a cash flow accretive business. Both of these underlying businesses are growing their cash flows at almost 16.5%, but Reliance Retail is causing a drag on the ROE. So cumulatively, while you see a consolidated level growth of 12%, which for Reliance is higher than mean, there is a drag on one of the core businesses. So that drag has to actually get overcome for you to have an IRR uptick from here. So it's not going to be purely energy dependent, is what I'm saying.
Right. Let's talk about the pharma pack. And I know you're overweight on that because you indicated that to me yesterday. But the overall pharma and healthcare pack seems to be more or less fully priced in for growth opportunities that these sectors offer. I mean, Nifty Pharma Index trades at a P of 38. How do you feel? Do you feel there's value in the pharma and healthcare pack? And if yes, any specific pockets where you're adding incremental capital to?
So for us, when you look at pharma and you take a slightly zoomed out perspective, right? From 2015 to 2022, you've been in a pharma down cycle specifically driven by US generics. You had not price inflation, but the rate of change of price deflation come down. Predominantly because a lot of the US manufacturers have filed for bankruptcy as US cost of capital has gone up. So the macro is in favor for volume growth to happen for US facing businesses. And many of these businesses have also diversified their product portfolio with an Indian facing ROE accretive businesses. So for us, our portfolio is across generics. It's across businesses with an India facing branded portfolio and CDMO. And we still see a lot of value in these three pockets. So predominantly from a large cap perspective, we have businesses which have diversified US and India portfolio. And in the mid and small cap space, our portfolio positioning is more so towards CDMO pockets. You rightly point out that there is been some level of re-rating in pharma from, let's call it a year back. Many of these businesses used to trade at roughly 40% of the PE that we just spoke about. But as long as growth comes in, but more importantly, margin expansion happens, because some of these businesses that I'm talking about, that net cash to market cap is roughly at 6.5%. And the last time I saw this was around 2014-15. So what you're going to see in the next 2 years is an increased M&A pickup, because the balance sheets are clean, cash accretion is real, and you're going to see M&A pickup. So from here, the quality of M&A in terms of capital allocation is going to decide future returns. So that's where bottom up is going to be important, purely from a capital allocation perspective. But we continue to be bullish, yes.
Across global and local players, your top 2 to 3 bets in the sector, Naveen, at the current juncture and the current valuations, and of course also ahead of earnings season in the pharma pack.
So, leaving stuff, we have roughly 7 names in terms of pharma, amounting to almost 20% of our portfolio. So if, like I said, we are bullish across Indian branded generics, there we have a portfolio exposure in a company called Eris Life Sciences. And in terms of a recovery story, within the CDMO pack, we like Piramal Pharma.
Right. Naveen, when you indicated to me that you're one of the few PMS advisors or fund managers who actually hasn't been too bullish on banks, I had to stand up and take notice. Credit growth for the banking space has been in the range of 13.7 to 13.6% over the last 2 months, and that makes me believe that the earnings downgrade from here is rather limited. But there is a potential for an upside, only because there are large capacities to lend to as well. Do you agree? Do you feel like it's a matter of time and you may turn constructive of banks, or would you avoid banks for now at least?
No, I agree with the entire hypothesis that you laid out. I think the credit growth is likely to be strong from here. What I am not confident of is this credit. So in the previous cycle between, let's call it pre-21, our financial exposure coming predominantly from banks was on average 40% of our portfolio. So it's not like we've not been overweight banks in the past. Why we've dropped our banking exposure to as low as 3.5% today is this credit growth is not, according to me, translating into ROA expansion. See, one of the reasons, if you take a step back and we look at Indian banking at a price to book of 2 to 2.1 being cheap versus global benchmarks, is because our ROAs are roughly 2.2 times that of global benchmarks. Now, in an environment where I don't see ROA expansion in an accretive way, what that means is my ROE, which I was used to at 18 to 20%, drops to 16%. And this ROE, unless and until I see it go back to an 18% number, I don't know whether price to book at 2.1 is cheap or not. From a 10-year perspective, it does look cheap, and hence there is value, like you rightly pointed out. But my incremental IRR has to come from an ROA expansion, which is not where I'm confident of. So I'm not saying I'm bearish banking, but from an opportunity cost perspective, I still see there are better pockets of growth. It doesn't mean we will not look at banks, but unless and until I see an environment where I know ROA can accrete, I'm not going to go overweight banks.
What are you doing with power stocks? There's so much changing for the power sector. I mean, in some ways, it's going through a tactical or tectonic shift, right? With renewable energy generation, transmission being prioritized over traditional thermal energy, shorter gestation period, in some ways, better earnings, reduced exposure to coal price. With the likes of a power grid, they're expecting nearly 2 trillion rupees in capital expenditure. So very ambitious plans as well. And while momentum could have taken a hit, fundamentals are still strong. Your top bets in the power pack, and would you play power significantly between now and the next 6 months and keep adding to any sort of adding your allocations if there's any weakness?
Sure. So if I take a 3-year view, right, one sector that I would like to stick my neck out and say that we are bullish on is power. No matter how we look at it, if India has to transition from a slightly more services economy to a manufacturing economy, the backbone of that has to be power. At the same time, if we have to increase our GDP, that has to transition with a power capex expansion. And more importantly, if we believe the data center story is real, and globally, we are going to be talking from a mobile-first economy into an AI-led economy, there again, you need power. So no matter whether I look at compute, whether I look at manufacturing or a data center-led economy, the backbone of all of this is power, which we have been underinvested for a good part of 10 years. Globally, right? And India, one of the reasons we are in a better off position is we never said no to thermal, right? So I think what you're going to see is growth in thermal annualizing at around 12 to 14%, growth in renewables, including nuclear, going much higher at 18 to 24%. But the problem is, today, renewable growth does not mean ROE expansion. So what I would like to play within power is a portfolio mix of a company which has the capability of doing thermal and renewable alongside. So our largest exposure there is in a PSU with NDTV. So that is where I would continue to look at. I would not preferably look at a renewables only player, because you might get incredible top line growth, but I'm not sure that translates into an ROE expansion. So I think I would want to balance out the two. And as you rightly nailed it, in terms of power capex does not incrementally translate into demand accretion unless and until you have the transmission layer sorted out. So the transmission layer legs also has room to expand.
I wish we could chat longer, but one last question before I have to wrap up this conversation. 3 to 4 stocks across sectors, across market cap that is on your watch list, and you would use the next, say, 5 to 10% correction to increase allocation to these stocks.
So more than names, I think I'll lay out the sectors, right? And the way we think about this, mostly we go after market leaders in any of these sectors. So I spoke about non-lending financials. There we continue to be overweight insurance. Insurance continues to be one of that in our top 5. You would see the stock actually figure in. We continue to like pharma. There again, we are incremental buyers. If there is a dip. Then third is auto two-wheeler. There again, we own the market leader. They continue to execute. And fourth, I spoke to you about power. So these are the 4 sectors we continue to be bullish on, and that's where we would continue to add risk at every given opportunity.
Right, exciting. Thank you, Naveen. So good talking to you and getting a perspective from you. Your fund, of course, has beaten the index in the last 1 year and over a longer period of time as well. Then that, of course, means that everything you say our viewers will be taking very seriously. Thank you, Naveen. Have a great day and we'll see you soon. Well, the big story over the last few days has been about how FIs have been rebalancing their portfolios and moving allocations or incremental flows into the Chinese and Hong Kong stock markets. Those markets, for good reason, have actually done phenomenally well over the last few days. China, for example, is up 30% in the last 13 trading days, while China as well has had a phenomenal run over the last few days. Well, while you're an investor who's twiddling your thumbs and getting disappointed and worried about the fact that Indian markets are selling off on back of this money moving to China, do not be too disappointed, because as an Indian sitting in India, you can actually diversify your portfolio to make allocations to Chinese stocks. Now let's take you through how you can do it. There are a few ways in which an Indian investor can actually invest in stocks outside a country. First up, you can either do it through mutual funds or you can do it through ETFs. I'm going to start by taking you through which are the ETFs and which are the China-focused funds that you could invest in. Let's start with Edelweiss Greater China Fund. Now, this is a fund that focuses largely and has a major chunk of its investments made in China, Hong Kong, and Taiwan, which is more popularly known as Greater China. This is a fund of funds. So what this fund does is it doesn't invest directly into these markets, but it invests in the JP Morgan Greater China Fund. So it's a fund of fund vehicle where the Edelweiss Greater China Fund is investing in the JP Morgan Fund. The returns of this one have been good. In the last 1 month, it's done about 3%. 3-month return is about 13.5%. And 1-year return is largely what the Nifty has done, with a return of over 20% for China and Hong Kong at a time when those markets have been underperforming. The other way to invest in China and Hong Kong is to do it through ETFs. This is a very popular mechanism. It's a low-cost instrument, and the way you do it is that you buy into the Nippon India ETF Hang Seng Bs. ETF tracks the Hong Kong index pretty much with the usual tracking error, so not too much in terms of what Hong Kong does. This is a passive fund, which means that if the Hong Kong index goes up, the Nippon ETF, which invests in this Hong Kong Bs, also goes up. The returns of this one have been pretty solid and in line with what the Hang Seng itself has done. In 1 year, it's done returns of 22%. In 3 months, it's done about 3-odd%. So if you only want to play Hong Kong, which is an ancillary of China, this and through a low-cost liquid instrument, this one becomes a good way to do it. The other one to do is the Mirai Asset NYSE FANG Plus ETF. Now, what this is, it invests in the FANG stocks, which is Facebook and amongst others, the stocks that are listed on the Nasdaq. But what it also does is it has some exposure to Chinese tech companies. So companies like Alibaba and Tencent are present in the NYSE FANG mutual fund. So again, this may not just be China focused, but a small allocation of this fund does make investments into Chinese and Hong Kong stocks. The returns have been great, but that's not driven by the performance of Chinese stocks. It's been driven by how well the Nasdaq has performed this year. The index, of course, is up about 54%. What you also want to keep in mind is while these are some of the funds that are available and ETFs that are available to invest in the Chinese and Hong Kong stocks, a few other ways to do so is to do this through foreign brokerages. So if you have a Zerodha account and you have a good understanding of Chinese and Hong Kong stocks, you can simply register on these platforms and go out and buy specific companies that are listed in China and Hong Kong. The other way to do this is you can also buy into the New York Stock Exchange. A couple of the Chinese larger tech companies are listed on the New York Stock Exchange, on the Nasdaq and the NYSE. So that's largely how you could make hay while the Chinese markets are witnessing or experiencing or set to experience an outperformance from here on. But a couple of things you want to keep in mind. These funds are high risk. Remember, there is no home bias here. So obviously what happens over there, you are slightly disconnected with. So it might be tough to get a pulse of the market since you're not living in China and Hong Kong. You should consider this as a diversification instrument. So don't go out there and bet the house on these funds, but off your portfolio, talk to your advisor. Maybe a 5 to 8% allocation to Chinese and Hong Kong stocks could be a good idea for now. So those are a few ways of how you can take advantage of the rally that's expected across Chinese and Hong Kong stocks. With that, completely out of time. Thank you for watching.